Pledge of a moment of silence, please should have it. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right, everyone, thanks. So our first order of business then is to approve the agenda. Everybody had a chance to look at it.
I'd like to ask a question on that. Executive session. These are members that are bringing this to the board or stuff. Should we not be doing that in the regular session instead of executive discussing it? If it's an executive session, should we not be discussing this in the regular session? Because it's members who did not know what's going on. I mean,
What's the response?
Then there's legal.
Right, yeah, because it did come through the legal entity.
and so because they've got a lawyer involved in the situation, that's why we go to executive.
They went through,
Absolutely. Yeah.
So that's why I'm trying to clarify that.
Yep.
Okay.
Mr. Chairman, I'd like to add a item in executive session. I have it's a budgetary ask, but it's for a specific member, so I think it is appropriate for, I mean, we can come out
okay,
of executive session, but it's time sensitive. So, and it's a non-budgeted item, so, and
okay,
it's member specific, so I kind of like to,
we'll
I
add,
think we have to do it.
we'll add that. Okay, so I need a motion to approve the agenda with the additional. Second. First and a second. All in favor, say aye.
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 Okay. 7-0, 8-0. Next item on the agenda then is we got a report out.
Yeah, I mean, you guys, I think most of you, maybe Steve, or you've met Earl, yay, nay? Yeah. So Earl is with London Woody Group, who is doing our audit. And so he will be reporting out. The other introduction you'd like to have?
Nope, everything else is negative. So keep it limited to that. All right, well, did I hit every seat with a copy of the audit report? Hopefully. If not, there's some extras over there. If you would, go ahead and turn to page 4. Oh, thanks. Turn to page 4 and I will start there on the balance sheet. Just to give you, for those of you that haven't heard how I present the audit before, I'm going to go through some stuff, but I go through your financial statements and I kind of try to look at them in my mindset as a cooperative and what they tell you, not only from a financial standpoint, but changes a year over year, but also like specific to what your balance sheet tells you as a cooperative, how your margins versus your cash flow actually matter from a cooperative standpoint. So at any point in time, if I get into the weeds or whatever, and you have a question, just stop me as I go. You don't need to wait till the end. I don't mind being interrupted. I've been married 23 years, so I'm used to it. So feel free to interrupt me at any point in time. So page 4 is the balance sheet. What you flip past is the audit opinion, which is my opinion. And this is kind of, it's something you probably hear every year, but it is important for those charged to governance to remind you. The audit opinion is actually the only part of the financial statements that is mine. So the financial statements are yours. I just received a management representation letter that acknowledges you gave the financial statements to me. You got the financial information. You didn't hide anything from me. You're not aware of any fraud. You're not aware of any items that we requested that you didn't provide. So these financial statements are yours. What an audit opinion does is states whether or not these are free of any material mistake. And a material misstatement for somebody out there that is not an auditor, not an accountant, or not familiar with financial statements, and would like to know, like, material is an accounting word. It essentially means an error that, if it were to exist, may make the user of the financial statement change a decision they might make. And there are several users of the financial statements. You guys are users of the financial statements. Your lender is a user of the financial statements. Your members may use the financial statements to gather decisions that they may make. So materiality, it lets you know one thing, that we do not audit down to every penny, but we do audit to a level established by us based on accounting standards that makes it to where you can, if the lender wants to say, are you reliable to lend $2 million to? They can rely on these financial statements to be free of any error that may make them change that opinion. So in other words, if its accounts receivable was misstated by $1,000, if we found it, we'd report it. But if it was misstated by $1,000 and your lender, looking at your $63 million balance sheet, was trying to see if you could absorb $2 million worth of debt, they're not going to change that decision. If it was misstated by $200,000, they might change the decision on what they lend. So that's essentially what materiality means. So our audit opinion, which it was an unmodified or clean opinion, states that these financials are free of material misstatement. Another important thing, though, is what an audit opinion is not. And I think this is very important because it doesn't happen as much now, but I know years ago, I'd come out and say, I'm doing the audit presentation. I said, well, we have a full agenda, so just let them know whether or not it's a clean opinion or not a clean opinion. And we got a lot of stuff going on. But the reality is, as you receive a clean opinion, it's actually very difficult to not get a clean opinion, because there are only really two main ways that you would not get a clean audit opinion. One would be if I came in and I found an error in your financial statements, proposed an adjusting journal entry to fix it, and you said, no, I'm not going to fix it. Sounds odd, but it has happened to me once in my career where it was based on the retirement. They said, we don't want to do this because people are already hammering us on the retirement. I said, okay, well, I have to modify the opinion, basically stating so they'll know it's misstated, or I can withdraw and you can try to find another auditor that might sign off on it, but I can't. And in that case, I did withdraw. I have no idea if they found another auditor, but that, because there was an error that existed and they wouldn't fix it, would have resulted in a non-clean opinion. The second would be if there's something in your financial statements I simply can't audit. I did an electrical engineering company one time that had $1.5 million worth of inventory on their books. They had absolutely no records to support it. I could look out their window and see inventory, but I am not talented enough to know whether or not that was $2.5 million, $500,000, and they had no records to support it. Their inventory system crashed early on, and they just didn't rebuild it. They just kept purchasing through it, and whatever flowed through their account flowed through their account. So in that case, they received a clean opinion except for inventory, which I stated I couldn't audit. I didn't say it was wrong. I didn't it was wrong. I just simply stated, except for inventory, they received a clean opinion. Why does that matter? Because that means that you could make all the errors in the world and have a completely inept financial reporting system and still get a clean audit opinion. Example, I did a cooperative out in the western part of the country. I've learned to say part of the country. It was in the western part of the country, but a lot of people like, what part? I was like, not Western Indiana, western part of the country. And the first time we did their audit, which was now 7 or 8 years ago, we went in and they had internally $2 million worth of net margins is what they were showing. After the audit and they corrected the adjustments, they had a $5 million net loss. I had to propose 37 corrections to their financial statements, which they posted. That changed their balance sheet by $17 million. They received a clean audit opinion because the financial statements included all those corrections. So the $5 million loss was in there. The $17 million adjustment was in there. But at the end, another thing that I'm required to report to you is, did we have to make any adjustments to your financial statements to get them free of material misstatement? Did we find any deficiencies in your control that would not detect errors in your financial statements? That is actually the results of the audit, letting you know whether or not you can rely on the financial statements throughout the year. Because you guys make financial decisions on a monthly basis. You have monthly board meetings, you review financial information monthly and make your decisions. That information comes from your staff and your controls, policies, procedures in place. You don't wait once a year to see an audit report and say, okay, here are all our decisions for the year. So knowing that you can rely upon the information monthly is much more important than whether or not you get a clean audit opinion that contained a bunch of errors that I found and corrected. It means, because in that case, the example I just gave, those people made decisions all year long thinking they had $2 million worth of net margins and they were hurting. They couldn't figure out why they were borrowing more than what they thought they should because everything else looked right. Well, it's because it wasn't right. They had a $5 million net loss. So they relied upon information, and that's why they made a lot of corrections, and now they're a very clean company. But so when I get to the end, I will go over if we found any deficiencies in your controls we think need to be fixed. I will go over if we had to propose any adjusting journal entries to get these free of material misstatement, and that really lets you know whether or not it was clean or not. I save it till the end because that way you have to pay attention to any boring thing I say, because that's the important part. So you got to pay attention. Any questions on that? Let's go ahead then and start in the balance sheet. I don't have a lot to go over because you didn't have a lot of big changes this year, which given the environment, inflation, everything that's going on, it's not a bad thing to not have a lot of big changes from 22 to 23. A lot of cooperatives had a lot of pressures put on them this year from the environment. So the fact that you didn't is a good thing. If you start there in the middle of the page, you can see that your total assets grew from 61.3 million held up to 63.9 million, almost $64 million worth of total assets. So about a $2.7 million growth in the current year. If you look at the very first line, your utility plant, the plant that's out there to distribute the electricity, that grew $2.5 million. So all your assets went up 2.7. 2.5 of that was an investment in utility plant. If you look at your investments, those went up another $300,000, or $200,000, roughly at 300. That basically made up your increase. Most of the reason your investment went up was your allocation from your G&T. Now, why that's important, if you look at it from a cooperative standpoint, you guys are designed under, I would call it like a socialistic economic model. Doesn't work in government. I'm not here to promote anything political, but an economic model of a service was needed in an area that nobody else would provide it. So members pooled their resources together in order to receive the service, which means all their resources will own assets or owe on the assets if they take debt needed to get the service. So as a cooperative, you look at your assets, most of the assets that your members either have equity in or owe debt upon should be the assets that help them get electricity. You're not designed to be financially strong. You're designed to be financially stable. Make sure you're able to operate so that you can get the service out. If you look at utility plant and service, 62 million or 41 million. If you look at investments, 16.5 million of your investment is your investment in Hoosier, which essentially is an investment in plant. You're investing in a G&T so that they can get you the power that you can distribute. And then you look in the third line down at current assets, you have about $800,000 or almost $800,000 in your materials and supplies, those items that will become plant once they're put in service. Those three things make up 92% of your assets. Which means when you look at it from a cooperative standpoint, yes, look down at the bottom section, we have $39 million of member equity. Members own our assets. You have $18 million of long-term debt, first line equity and liabilities that members are going to pay back. But they're paying back on or own almost all, 92%, the actual assets that are needed to get them electricity. They're not investing in a company because they want to be profitable. They're investing in a company because they need electricity, and you're a cooperative. So you need to collect from them what it takes to serve them. Seeing 92%, that is among the higher just assets dedicated to electric service that I work with. And if you don't know, I work with about audit now 45 cooperatives across 5 states. That range is anywhere from 92%, which is the highest percent. There's a couple other that high, down to 54%, which I'm working with to let them know you're holding a lot of liquid assets that aren't really serving to get electricity. You should probably be returning it. Your assets at 92%, another way to look at it, are non-liquid assets. You have a responsibility to return patronage, but 92% of your assets are plant. So unless a member would accept a deed to a pole as a retirement, you have to figure out a way to liquidate an asset that's actually necessary to give them electric service, which is why, and I won't get into all of this, I could speak forever, but Brett knows this, he's probably heard me drone on. Patronage capital planning really comes down to one thing. You can never not have equity in the cooperative. You're required to give it back to the members, but you can never not have it because you have to have 92% of your assets to get electricity to your members. So you're either going to owe debt, I guess you could be 100% debt, so the lender would like that, but, or you're going to have equity. Your members have to own something to get the electric service. So if you look at your assets and say, okay, well, most of the assets that we ask them to own are the ones they need to get the service. Then you look at the other set, Patronage capital planning, all you ever are really doing is shifting who owns the assets. Because we have to accept that they're going to have to own the assets so they don't get electricity. So you decide who should own them and how long should they own them. I've been on Johnson County's lines for 22 years now. On average, in the state of Indiana, it takes about $5,000 with the utility plan. It depends on the cooperative, but it's pretty darn close to at least $5,000 to get electric service to a house. To be able to buy a house, turn the light on. If I bought a house on your lines tomorrow, it would take on average about $5,000. I don't pay the buyer or the owner $5,000. I don't pay you guys $5,000, but I get that plant to turn my lights on. 22 years on Johnson County REMC, I am nowhere close to $5,000 with the patronage capital, which means I still haven't even paid for the plant it took to get my lights turned. How is that possible? The other people bought it and they own it. And there are people that don't use it anymore that own it, which is why when you think about patronage capital planning, which is not why I'm here tonight, I got it from an audit standpoint. But when you think about patronage capital planning, you can look at your balance sheet and say, well, this is what it's supposed to be. Most of our assets are what are needed. Well, then you have to decide, okay, well, I bought a house. I don't have $5,000. Maybe it's reasonable that I pay 50 cents a month on my bill so that you can pay people back that don't use the plant anymore, which is why I say decide how long they own it. Is it 30 years? Is it 25? Is it 35? I don't know. There's no perfect number. But at some point you have to say, the only way that I'm ever going to buy my plant is to accept that I need to buy my plant. You got to collect from me so that the people that don't use it anymore are paid back. Now, I could get into this again, like I said, forever. Some people, that's a hard concept to accept. Well, I'm not going to charge somebody here to pay it back. But the fact of the matter is there's only one source of revenue, cash, to your cooperative, and that is your members. Which means if you ever pay a liquid asset back to a member in a patronage capital retirement, you by definition had to collect it from another member. It's just a fact. So you can look at it and say, well, I don't want to do that. I don't want to build it in my rates. Where else do you get money? It's built in your rates, whether you accept it or not. So understanding that and then coming up with a plan of, yeah, we're building in our rates, but it's based on principle. If we think people should only own it for 30 years, 40 years, I don't care what the number is. Helps you, I think, understand a little bit more of why you would build it into your rates. It's not just oh, I know we have to return it and we're not budgeting well enough, so we need to up it because we have to retire patronage. No, you're required to, and it actually makes sense to build it in as part of your plan. Told you I look at financials as cooperative, not necessarily normal financial strength. So, all right, any questions on the balance sheet then? We'll go ahead then and flip one page to the statement of revenues, which in my opinion is easily the least valuable statement of an electric cooperative that there is. You fall under the IRS code of a not-for-profit, but in reality, you're not designed to not create a profit. Profit is equity. Obviously, we just went through, you have to have margins, you have to have equity to own your plant. What you are designed to do is only collect the amount of cash from the member it actually takes to serve them. So when we get to the cash flow, we'll kind of go through and see what, if you look at the bottom of the page, $3.5 million worth of margins, what's that actually mean on what you collected from the member and where did it go to serve the member? But I will highlight some things that changed your margins because they did go from 1.2 up to 3.5. A big driver of that has to do with your gross margin, which is your first two lines. The revenue that you collect less the purchase power. Last year, the revenue you collected from the member was $9.1 million, less the power you paid out was $9.1 million. It was $35.6 million what you collected, less your power bill, you had $9 million left over. This year, that ticked up to about 10.8. And mainly had to do with the tracker pass through, as well as some rate changes that are going on in Hoosier. I believe they're doing rate changes again, but I did hear last night that they're putting it off till 26. So take their word for it, I guess. We'll see what happens, but I know they're going through some stuff, but That's where your gross margin went up. It was basically the changes from the G&T rate where you passed through the tracker, and then you had some benefit this year basically because of the weather. When they restructured the rate, those with higher commercial load, because of the weather and residential use being down, you probably experienced one of your lowest demand years that you've had in years because of the way that they redid the rates, which was a good thing, but it's also kind of a unique thing for this year because the weather was, it was very non-productive, to put it mildly. If we go through then some of your other operating expenses, your operations and maintenance, operations was up a bit. That mainly was due to payroll. You hired some new people in. You had I believe, 2 new apprentices. You also had a new meterman. So you see that overall that kind of flowed through and increased your operations about 300,000. But that was then offset by your maintenance cost that actually decreased from 2.7 million down to $2 million. So it went down by $700,000. A big portion of that is because you spent $500,000 less on tree trimming in the current year than you did 2022. It's a good thing, but it's also a cyclical thing. Like there's going to be years where it's lower. There's going to be years when it's higher. So the fact that it decreased, it probably was up. If I looked at 2021, it probably was up in 2022 based on 2021. So it's just kind of a cyclical thing that you have to do. If you fall lax on right-of-way clearing and tree trimming, it impacts not only your responsibility that's non-financial, reliable service, but it also impacts line loss, which is a real dollar cost. It's power that you're buying, you can't sell. So that decrease offset and more than offset the increase in your operation cost. Everything else kind of held steady, except if you look at the very bottom line of operating expenses, you can see that your taxes went down from 377 to 130. That is something that you probably went over with your auditor last year as well. But in June of 2022, they repealed the URT tax, which means you had 6 months of URT in the prior year. This year, you had no URT tax applicable. URT is 1.4% or was, thank God, 1.4% of every dollar that you collected for service. So that is gone now, and that's why you see your tax drop off. Last year, it was about, like I said, 6 months worth. This year, it's gone. And I highly doubt that will come back anytime soon because you said you're new. I don't know how new, but so you weren't here for it. When they repealed the tax, the state of Indiana made you put on the bill, thank your congressman. And I'm not joking. You literally had to put on every bill, thank your Congress because they repealed this tax, which means they're going to have a hard time putting it back on there. And if they do, I recommend, even if they don't require it, thank your congressman for putting this tax back. So I believe that's a savings. Yeah. It was kind of, it's a side note, but for some smaller utilities like water utilities or small investor-owned gas utilities that don't have sophisticated software, it costs them a lot of money to figure out how to put it on the bill. So that little thank your congressman, unless they wanted to go through 5,000 bills and type it to get their software updated, some of them paid like $20,000 to $30,000 just to figure out how to put it on their bill, which was about the tax they paid for a year. So they're saving it now, but it costs them money just to, that's a side note. So really your operation expenses, they went down as well, which increased your margin. So you had a higher gross margin from the change in rates. You also saved money on your operating expenses, primarily URT and your tree trimming being down for the current year. And then the other reason why your margins were up is the very first line in non-operating. You had a higher allocation from Hoosier this year than you did the prior year. Everybody did. Their margins were up in 2023 compared to 2022. So everybody's allocation was higher. You do not receive the cash for the allocation that you retire prior allocations. So $200,000 of your increase was a non-cash allocation increase from them. Any questions on that? Well, then the last page I'll go over, if you flip to page 7, a couple pages over, much like your balance sheet, when I look at it and say, okay, as an electric cooperative, most of your assets should be the ones that are needed to serve a member. The statement of cash flows is by far the most important statement because it lets you know what we just went through, $3.5 million worth of margins. What does that actually mean on what did we collect from the member and where did their money go? That top section there, cash flow from operating. I'm going to simplify this cash flow down because for a cooperative, it really breaks down to 3 or 4 main things. That top section where it shows that you collected $4.2 million in operating cash, that is essentially, not perfectly, there are some things that fall lower, but for the most part, that's as if you went into that statement of revenue that we just went through that showed that you created $3.5 million worth of margin and converted it to cash. Depreciation expense, that lowered your margins. You don't pay for that. Your patronage allocation increased your margins. You don't receive that. You also have timing differences on payables or receivables. So if you look at that top section, we can say, okay, we collected about $4.2 million from our members in excess of what we spent on a cash basis for our operating and non-operating expenses. Now that number is important because that is what you have left over to pay for three main things in electric cooperative that you do not get to offset margins with. The first and the largest is the first line in cash flow from investing. You did put $4.2 million worth of plant into the ground. The second is the second line in cash flow from financing. You paid off almost $900,000 in borrowings. So if you took everything else out of the equation, you have to pay $900,000 off in debt. You would have collected $900,000 in revenue. There is no expense for that. So you'd have $900,000 in margin. But on a cash basis, you collect it, you pay your debt, you have $0 in cash. The last thing then is the very bottom line on cash flow from financing. You get $4 million back to the members. So if you break down, take borrowing out of the equation, take your investment returns out, and you look at just saying from a rate perspective, our rates are set up. I only want to collect from the member what it takes to actually serve the member. Collected $4.2 million from the member in excess of your expenses, then spent $6.5 million putting plant in the ground to serve the member, servicing the debt of the member, or returning it back to the member. Which means had you not borrowed anything, which borrow because you put plant in the ground, it's going to last for 30 years. So that's a way to equitably share the cost. But had you not borrowed anything, you fell short by $2.3 million this year. Which means another way to look at it, your break-even margin for this year, had you not borrowed, is $5.8 million. $5.8 million worth of margin, if you took borrowing and investment returns out, would have gave you exactly the amount of cash you needed to only collect what you actually spent to either put plant in the ground to serve the member, service their debt, or give it back to them. That's why I say you're not designed to not be a not-for-profit. It makes sense that $5.8 million would be your break-even margins. You put $4 million worth of plant in the ground and you paid $900,000 worth of debt off, and those don't offset margins. That alone drives it up to that. Obviously, your cash did not go down by $2.3 million. Why? Because you did borrow $1.5 million, approximately 30% of the plant you put in the ground. So if you borrow it, you're not going to collect it in rates. You're going to collect it over the period that you borrow. The second thing is that the last line in cash flow from investing, you got about $760,000 back from your investments. Those are the redemptions on the patronage capital that you got. So your margins went up by 1.2 from allocations, but the cash that you got was about 760. So 2.3 was what you were short on rates, but you got 2.25 million from either borrowing or your investments coming back to you. So you fell short by $50,000. If you look at the very bottom section, the third line from the bottom, your cash went down $50,000. From a GAAP standpoint, we're required to put all these different lines and all these different changes. But from a cooperative standpoint, the primary thing is what did we have left over after our operating expenses? And where did it go? It should go to three main things. Put plant in the ground, pay the debt off that service, put plant in the ground earlier, or give it back to the member. And this year you can see that your goal was only collect what we need from the member to serve the member. You collected $40 million with that goal in mind, and you missed it by $50,000. And you missed it to the negative, which means about a 99.99% success rate on only collecting what you needed. But you have to figure out how to give them $3.5 million back sometime in the future. Because that's your margins, that's your equity, and you're required to. And a year that you actually collected no more cash than you needed, a little bit less than what you needed, you have also been obligated now to return $3.5 million to the member. That's why I say the only way you can do it, obviously, is either put it in rates or borrow, which will be in rates as well, to shift that equity. Any questions on that? I apologize. I've been told that sometimes first time hearing me is like drinking from fire hose. I'm covering too much. I very much apologize. Well, then the last thing Audit, is at the very back of the financial statements, there is a stapled letter. This is what I alluded to at the very beginning. There are a couple things here that if we identified any significant difficulties during the audit, if we had any disagreements with management, if we identified any internal control deficiencies, if we had identified anything, basically anything that we believe is required to be brought to your attention, we would use this letter as our vehicle to do that. Nothing in the current year was identified that was necessary to report. So basically the letter lets you know what we would tell you and then lets you know that there was nothing to tell you. But the other thing that we do is at the very back, the last page, as I talked about earlier, if we had to propose any corrections to your financial statements or adjusting journal entries to your financial statements to get them free of material misstatement, I would go through those with you and I would let you know the nature or the reason why that was. In the current year, we actually did not have to propose any adjusting journal entries to your financial statements. That last page, if we found an entry that we do not believe has a material impact, but technically should be recorded, we do report that to you as well. It's called a past journal entry, an entry that we found, but we did not record because we don't think it has an impact. And that entry is basically lowering your provision for bad debt. And this is something that I think you're going to work it down over the future, which is, it's fine. It's more of a smoothing impact. But that has nothing to do with like an error in your estimate or an error in your internal control policies and procedures to find it. This is actually an industry trend that almost every cooperative is dealing with. And that is that the fact is bad debt expense for a cooperative is much lower than it used to be. Why? Because people are retiring more passenger capital now, and you apply passenger capital to bad debt. If somebody's due $100 back on a passenger capital retirement, they still owe you $50 that was bad debt, you're not going to pay them $100. You're going to pay them $50 and recoup the bad debt for the other members. What that's done is significantly lowered bad debt expense for cooperatives. So the current members are not absorbing this old bad debt. When you retire it and get it off there, as you can see, what your bad debt used to be, the provision, what used to go bad, and you would estimate, which is all this is, which is why I didn't propose recording. It's about $276,000 higher than what industry norms are now. So an industry norm, when I look at bad debt, basically there's one of two ways to look at it. We look at like 5-year average write-off. So if you, over the last 5 years, have written off, say, $50,000, then a bad debt provision, what could go bad? What would make sense? It'd be about $50,000. Or another way to look at it is like an over 90-day balance. Normally, if somebody hasn't paid you for 3 months, they don't all of a sudden have a shock of conscience and pay you back. So some people, a lot of people actually, their bad debt is whatever is over 90 days. That's our provision because the odds are they're not going to pay us. It's going to go bad. Based on those two metrics, you're about $276,000 high, which is a good thing. It means your bad debt expense is going down. It wasn't due to an error. It's just due to the fact the industry has changed because of that applying capital credits. So I do recommend in the future, you work that down a little bit, whether it be an adjustment as a negative, not accruing bad debt. Probably will take a while to do that, but there are ways to work it down that are a little smoother. But the main thing is, as I talked about at the beginning, clean opinions easy to get. This is a very, very good report, clean audit, because the financial statements I were given are the exact same financial statements that are free of material misstatement, which means I had to book no correcting entries to your financials. So what you rely upon through the years that are a result of your staff and your policies and procedures in place are the same financials that I'm reporting are free of material misstatement. So that's a good, clean audit. And good for those charged with governance to know that you have people and policies in place that give you information you can rely on.
What would your recommendation be to start whittling this down? I mean, is this a 2-year thing or a 10-year thing, or what's usually?
The rules are changed. We're gonna have to work it down this year period, right?
It depends. You're gonna have to work it down
Pretty quickly.
significantly, yeah.
We stopped accruing on this last year because we knew it was getting high, but we didn't reverse.
So where does this go? Like what's the adjustment?
Effectively, we're gonna pick up $275,000 in income next year.
So where it goes, so when you accrue bad debt, you accrue what you think will go bad. So if you, like in a given year, if you thought $50,000 would go bad, and let's say your provision's fine, then you would credit or increase your provision that 50,000 will go bad, you'll debit bad debt expense. And then when you write it off, you take it out of AR and you offset the provision. But the expense part is hit by the estimate. So in this case, your bad debt expense is going to be a credit. And so in other words, you're estimating we're recovering, which you have recovered. There's the reason why your provision is higher is because in past years, and we're talking accumulated over time, whatever your retirement capital credits, you thought these would go bad. They in fact did go bad and you wrote them off. So bad debt expense hit your equity in the past and lowered it. But now you're getting them back. So you're basically getting revenues for expenses that you previously wrote off. So your bad debt expense will likely be a credit. It'll be a revenue. And it should be because you've collected on things that you previously expensed. So the net effect to equity is what was expensed before is credited now. And over time, it's just a wash. It just happens to be in the past, it was an expense. And now it's going to be a credit. It's going to be a revenue. But the equity effect is you're just getting rid of it.
When did that approach change regarding the bad debt versus the patronage?
It depends on the cooperative. Some have done it for a while, but really what you've seen is that as people started to retire patronage capital, more and more are getting more on the cycle or catching up, margins got higher. And the records behind the actual bad debts that you could apply or the people that you could find got better. So I think that what you're just seeing is if you, let's say you're on a 30-year cycle, the margins used to be about $200,000. Well, now they're $500,000, which means the bad debt used to be 10,000. Now it's 50. So it's just more of a factor of it's been growing. And probably what happens with your growth, like when you stop accruing, the problem is you're still collecting more than what you ever even accrued. So it grew off of that to where maybe you were only writing off 30,000 a year, but you were collecting 50. And so it actually made the provision go up. It was a gradual thing that probably for years it was just oh yeah, we know we got to work it down. And a lot of times you say, well, we'll just stop accruing. The problem is that wasn't enough. You actually have to, if you take the one-time hit, it's much easier to manage. Basically at the end of the year, you just adjust it around the 90-day and you're good. But the one-time hit will increase your margins.
And during the audit, we said, well, we'll take the hits this year, not last year. Versus, yeah, 20.
And really what it does is reallocates the capital credits in a roundabout way. So in the past, so you had capital credits in my example, $100 that you had to return to somebody, but they had $50 worth of bad debt. So you give them the 50, then you're going to show $50 in revenue over here from your collections that will get back into margins, which means their $50 because they had bad debts gone, but it'll eventually then flow back through and be allocated to the current members because those people didn't pay. So you're recouping for their equity what previously was diminished.
And we talked about this last time, Earl, for years ago.
Yeah.
Started.
It's grown gradually since.
I think our approach originally was, yeah, we're going to stop. Right. But then we also thought about big accounts. It's like, okay, you lose one of those. Well, that's not really how the rules are written, right? They're not looking at what it could be really. They're looking at what is it year over year.
Yeah. So, and we have some that, and I understand that fear, and there's a way, I guess you could go about with a contingent loss liability, but you'd have to justify it. And like, if you have a big account, let's say they pay $300,000 a month, you can look at it and say, well, what happens if it goes bad? But if you look at it and for 5 years, it's never come close to going bad, you can't play the what if game. The estimate is what do you think will go bad? Now, it's still an estimate because you might think 50,000 will go bad and 100. It's obviously an estimate, but the reasonable basis has to be based on not just what would the impact be if a larger customer went bad, but is it reasonable to think they're going to? And if they have a long history of not in any way indicating they could, then you can't really estimate that they would, if that makes sense.
One thing, the economy having been good for years and years and years now, we haven't had that natural down cycle.
Yep.
So you have a decade effectively of nothing's gone really bad.
Yeah.
So when it does the conservative approach is, well, eventually something's gonna happen. But the rule change takes that ability out of it.
Right. And there's nothing wrong with, I mean, even under the change, you can look at it. And if there's an economic downturn that you start to see affecting, like, for example, if you have a large customer, all of a sudden you see the load going down or whatever, to increase the estimate based on that reasonable, if they seem like they might be, then you can do it. In the example, I
Gotta
gave,
have a reason.
Right.
Right down.
it has to, right now, in the example I gave earlier of the cooperative that had the $5 million net loss, now they hadn't booked it correctly, which was the audit issue. But the reason they had the $5 million net loss was because they had 5 customers. Now they have 22,000 customers, but they had 5 in the oil and gas business that was so big, and the oil and gas business tanked the year that we went there. They all went bankrupt. And those 5 customers alone caused them to go from $2 million with a net margin to $5 million with a loss. The adjusting entry is they didn't book it. So they still had these receivables on the books that were 9 months worth of receivables. They weren't getting paid for them. The bankruptcy already was filed. So so yes, if you look in the industry, if you have a reasonable basis to change it, you absolutely can. But the potential impacts on a reasonable basis. Yeah. That's all I have, unless you guys have any other questions for me.
Is there anything you need to go over with the significant risks identified?
That's a good question, yeah, because I think that the way that we're required to word it is somewhat, sounds scarier than it is. So if we have a significant, if we have a deficiency or material weakness, that means we specifically identified something with you that we think you need to correct. A significant risk is based on our audit approach. So when we do an audit, obviously there are certain things you audit, but we also have to assess the risk of misstatement. And those risks of misstatement can be industry specific. So your industry might have a different type of risk than another industry. For example, if somebody ran a cash laundromat, they have a lot higher risk for cash misstatement than somebody that, say, runs a farm. But so that would be their industry. You have inherent risk of just any business that's out there. These are the type of risks that can happen. You have control risk. So we have to go through and we have to assess what are specific significant risks to you. In this case, management override of controls is one. That is something that is actually presumptive in all audits. It doesn't matter of industry. If you do not presume that no matter how good the controls that are in place or the people that are in place are designed and operating, that if management were to override them, they wouldn't work, and that's a risk, then you have to be able to document as an auditor how you think those controls are so good that management can't go in and override them. Obviously, you're probably never going to be able to do that. So that means from our audit perspective, we know that's a risk. So we have to do testing to make sure management didn't override the controls. And you do have mitigating things in place, dual check signing, stuff like that, to make sure that it makes it difficult for management to override. And then we test that they didn't. Cash, same thing. Cash is always just anything related to cash is a fraud risk. Fraud has no materiality. So noting that anything dealing with cash for any business could have the risk of fraud, we note that is significant. So we do additional testing related specifically around the risk of fraud on cash. So that's basically what it's letting you know that coming in, these are things that we consider significant. Obviously, we do all risk-based accounting, but those are significant to where we do additional testing to make sure the risk that's associated with those, because it could be so impactful, is properly audited. So it wasn't specific to anything you did wrong. That's upfront. That's actually established by us before we ever get out here on what's significant is. It's a good question. Thank you.
Anyone have anything else for Earl Weiss here? We good?
All right. Well, it's good to see everybody. You are my 8th out of 9 in 2 days.
When's the next one?
Yeah, I'm just glad I'm tonight at 8:30. It's virtual, but it's Southern Indiana Power.
Okay.
That's my last one of 2 day stretch.
Make sure you swing up to the courthouse and see the tree on our tower, you know.
Oh yeah, I've definitely seen that. My maps actually led me the other way. Really? It led me off 3 and through the back way.
Interesting. Must have been Greensburg traffic.
It could be, yeah. All right, well, thank you.
Thanks, Earl.
Appreciate it.
All right, so we do need to accept the audit results or report. So take a motion to,
Before I'll make a motion, but just clarification. I think we had this discussion in previous meetings. We're not approving the report, correct? We're accepting the report because I think there was some
yeah,
legal ramifications of us approving the audit report, which put the liability on us. We're accepting it,
that's right.
not approving it. With that, I'll make the motion to accept.
Second. I'll second. The
Second.
first and second.
Suzanne, did you have a comment?
I was
Okay.
just seconding.
Any additional discussion? All in favor, say aye.
Aye.
All right. We've accepted the results then, ETO. Next item, Brett, the safety minute and full moment.
My computer. Shut down. So it's gonna be-
Oh, you're having network. That's good.
Can we get to it? Yeah. All right, so we'll come back to that here in a moment. I think we'll jump down to approving the February board meeting minutes. We'll go to item number 6. And then we'll come back to safety limit. Give that opportunity. Sure.
Diagnostics, you have it too.
Yep.
I think it's not.
I have a grammatical,
Okay, where's that at, Jason?
old business nominating city members. That would be with a Y, not an I. I can do that. Yes. So go to this PC.
Patty Fisher.
Pardon?
Patty Fisher is why I'm not.
Y, not an I.
Oh, okay.
Search documents.
Is that the only grammatical
Yes.
change that you know? Anybody have anything else
Yeah.
from the minutes perspective?
DC/files.
All right, so we need a motion with including that grammatical change.
Oh, I'll make the
You're
motion.
making that motion?
Yes.
I'll
First
second.
and second. Okay.
I was doing this, sir.
Okay, so we have a first and a second. All in favor, say aye.
Aye.
Opposed, say
Aye.
Sorry. Clay, I want to preface that. Did you vote in favor of accepting the minutes?
Okay, I got it. Thanks.
Yes, I did.
Okay, thank you.
I got access.
we're getting our servers changed out.
So you're right.
I kicked out of. Had to call Sam. Taking out all the servers. I didn't realize this works great when you're plugged in with the Wi-Fi.
We're gonna be coming back to, item 4, just take a minute.
Okay, I'm good.
Okay. Okay, so for safety moment, I thought it was critical, especially for the board standpoint. So we have golden rules that all of our guys are taught. And these are the things that have to come, Nate, like breathing for us, right? These are the things they have to do. These are the most important golden rules. And so I thought it'd be good for you guys just to see these, to see kind of this is what they have to do every time they're working on our line. So number one is obviously they want to de-energize, right? So they got to de-energize wherever they're at. They got to see a visual open. So it's not always good enough to just have, a fuse out or whatever. They have to actually see an open. They have to test for voltage. So even if you see an opening, you think it's de-energized, they got to use a test for voltage. And then they're going to put grounds on. And so the reason you want grounds on is because if I'm working on a line and I put ground on here, but I don't put it on the other side of the line, if someone fires up a generator, it will backfeed up through that line. And if it's grounded on both sides of where they're working, it will basically kill the generator. So that's important. Gloves and sleeves. So there's situations that they have to have gloves and sleeves on, and then cover up all the potential differences. Obviously, the differences between the neutral and positives, or they have to make sure they have proper cover-ups. Those are the golden rules that our guys are always thinking through every time they're on a job. It's the repetitive part that, that when they do tailgates, when they get ready to do a job and they're doing their tailgate brief, these are the things that they're talking through, right? So nowadays we have a smart safe app on and they're doing tailgate discussions, and this stuff comes up and they've got to, okay, do we have to do this? Do we have to do this? So I thought it'd be good for you all to kind of see the golden rules and know what that means. Fair enough. Good. All right. So for our cool moment, we have, and I could not determine, I think we have never had a board member have a director gold status. Now to clarify, I don't know exactly when it came out, but I think it's only been like 6 or 7 years ago. So it wasn't around for a long time. But this certificate recognizes directors who have earned their CCD, so 5 courses there, their BLC 10 courses there, and are committed to continuing education through their service on the board. Director Gold is an addition to NRECA's Director Education Program. The Director Gold is geared towards directors who are committed to advancing their knowledge throughout their tenure on the board. And one thing I didn't realize about this is it's almost like a CPA also. You have to do continuing education to keep this. It's not like a one-time and done. So anyways, I got in the mail Jason's Director Gold program. So you got a award and I think a pin. Great. So congratulations. I thought that was cool. Congratulations.
Congratulations.
For your commitment.
All right, we'll go on to the next item for your information. Anybody have any questions related to topics presented in that piece?
matter, Brett, on the American Express, page 4, $8,200 for IT supplies. What would that, if you don't know, it's not,
It's the server. It's the server. That was one of our big CapEx items. Well, we've been having a little bit of trouble. We're switching over to our new servers. And that's not all of it.
He bought several computers on timed out. That's what those are. That's his computers. I think there's 4 of them, maybe 5. They're all stacked up in Sam's office on his desk. If you'd like to see them.
Just asking at this time, what do we do with the old ones? Replaced.
Depending on what they are, usually they're at the end of their useful life because they're normally 5 or 6 years old. Sam will hard drive, destroys the hard drive, and then he sells it. Any employee or he gets rid of it
Okay.
from a thing. You'd have to ask Sam.
Does. So we either get rid of it or like through that electronics thing that we do every year. Where they actually collect it and terminal down. Or we'll put them on like we do our vehicles or whatever. We'll post it for like $10 and if the employee wants it, they'll. And it just depends if it's strong, which 9 times out of 10, they're getting close to that.
Yeah.
We did have some monitors that were replaced. Those will last a while. It's the reason they're getting replaced is because there was 12-inch ones. And so those.
But some of them, they weren't even 50 pen type.
Also on page 12 and 13, is special equipment and materials, $2,000.
Check register?
Yeah.
12, page 12.
Bottom of 12 and top of 13. Seriously, that's special equipment and material. I just want special equipment.
Special equipment is usually a transformer or a meter, but
Pardon me?
special equipment's normally meters or transformers.
Okay.
We did get a bunch of transformers in this. I'm not 100% certain that's what this is, but usually UUS is transformer.
Oh, okay.
I'm thinking that that's probably, we got in like 70 transformers this month. I think that's one of the invoices related to that. But I'm not 100% certain on that individual. Sorry, I have to look it up. Yeah, I can.
I'd say move on. Okay. They'll be looking. All right. Anybody else have anything for you? All right, so we'll go to item number 7, the CEO update. Yeah, so a couple things. So we have our Culture Company Vision Day. It's April 2nd, so it's next Tuesday. I put this in the report but I'll mention it here. So as part of the day's agenda, we're having a speaker come in. His name's Dr. Henry. I think some of you may have heard him. He's spoken for IEC a few times in the future. He talks about leadership and culture. Very good speaker. It goes right along with kind of what we're doing for the day. So I'd like to invite you all. He is going to start speaking at 12. So I'd ask if you want to come Tuesday to be here at 12 o'clock. And then he's going to speak through 2:15. So we basically got it for 2 hours. If you can make it, it's really good.
It's impactful. I'm looking forward to it. I think quite a few of our employees are really looking forward to it. I think you've heard him, right?
And I think so. I'm going to piggyback on what he said, though. If you do have that opportunity, presents itself, certainly. If you're here at 12 to 2:15.
I was going to show a clip of him.
Could you repeat that date again?
It's next Tuesday, April 2nd, Suzanne.
Thank you.
Yeah, and if you want to come, I'd be here about noon, and he'll probably talk for 2 hours. Well, I know he'll talk for 2 hours. He's a very motivated, motivational. He's a good speaker. Matt's heard him also. If I was going to show a clip, but what I would suggest is just Google Dr. Henry Motivational, and you can see a clip of him. It would be worth your 2 hours. And the office will be closed that day. So I kind of want to just give an update on the operations manager position. I've had a few questions on it. So we had over 40 some resumes submitted, 3 internal candidates. We have narrowed that down, and we are actually working on our second in-person interview. So we went through all the phone calls. We narrowed that down to internal candidates. There's 3 and 2 external. We are now going through the second in-person interview. So kind of where we're at. I said I'd like to have this done by the end of the month, but we also have to, I want to hire the right person. Sure. So it may take us another month. Just depends on how long to get through that. So questions on any of that?
Who's been doing it in the meantime?
So myself, Jenny Burkhart, because she's kind of been filled in for that admin role. And then Matt, Jenny M, Jeannie, and there's a few other. Crystal's got some stuff too. So we did, before Pat left, we took all of his duties, like Matt's doing time at approval. So we divided up everything we've divided and conquered. I will say we've been able to keep, there's no progressive, no planning, nothing like that, but we are keeping the ship sailing.
Not rudderless is what you're telling me.
Yeah, well, yeah. Sometimes it gets stuck, but.
All right, to answer questions about that. One was 34, 40 class poles, and the other one was a 75 kVA transformer. So, thanks.
All right, next is a Kaizen event. I brought this up the last couple of months, but I just want to make sure everyone's clear on kind of what we're doing here. So we have in the budget last year and this year a project manager position. Crystal took that on originally. We've moved her back in. She took her old position. So I've left that position open because what I'm doing is I'm using the dollars as to contract this work out. So Toyota has a division over in Columbus where they do consulting work for us. And so they have been in, we've done 3 events. They're coming in mid-April for 2 more days. That's the work up there that you can kind of see we've started to do. So I just want to let everybody know we're not going to hire that position right now because we're using those dollars to offset and be able to do this. So just wanted to bring that up again. April 9th and 10th, it looks like it's our next 2 days. I'm hoping by the end of that, we'll have a pretty good, I don't want to say fix, but an improved streamlined process and some visual management for our service report process. So I'm excited about it. These folks have the expertise in how to do a Kaizen event. And so I think it's money well spent.
And you get the same person that you had.
Yes,
First,
absolutely.
and you were very pleased with.
Very pleased. Very knowledgeable and continuous improvement. You know, it's interesting because even though it's a manufacturing continuous improvement process, it works on any process, no matter what industry you're in. So been very, very beneficial so far. Fiber project update. We are going to spend a little time on that tonight. Some breaking things and then some decisions coming up as far as how we want to structure the business. So we'll be discussing those in a line item later. And that's
all I've got from CEO report up.
All right. So last month, if I'm not mistaken, Brett went over these company projects, the next item. And we need to approve those tonight, or
Yeah, I put it back on it's item B under, well, 7B.
so does anyone have any questions? We need a motion to approve company projects.
I'll move. Second.
We have a first and a second. All in favor, say aye.
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 All right, thanks. Let's go to the next item, the company metrics review, guys.
All right, so we're gonna go back to February, which was a little different story than January. So if you look here, our median temperature was about 16.3% warmer than our 5-year average. So February was quite a bit different. So if you look at purchased energy is down about 4.8% than our 5-year average. And then demand was down about 7.9%. So all that total is about, let me see here, we are right around 5.4 above. I think we were 8 something last end of January. We slipped down to 5.4. So we're still above budget, but took a pretty big hit in February. If you go to retail sales, you can see residential skyrocketed in January due to the weather. We're still above budget, but just barely in February. Commercial stayed pretty solid above our budget. Industrials have hit or below. That's primarily from one individual. And then transmission has been essentially just over budget. If you look at the daily SAIDI, I mean, we had the one outage on 112 due to high winds. But other than that, it's been quite good. Lost consumer hours were just under the 5-year average. And then number of outages basically flat on our 5-year outage average. Any questions from February's metric reviews? Anything else that I had in the packet?
Not a question, but just an observation, because I was here last night, we were talking about this, with the extreme winds we've had. And I know we're talking about March, not February, but with the extreme winds we've had for the last 2 to 3 weeks, to have the system stability that we've had, I think bodes well to say that our reclamation and right of way and everything is working.
Absolutely. Go talk to any of our linemen right now. It is, when we have these wind events, go look at www.indianaoutages.com. It'll show you it's way behind, like a half hour, 45 minutes.
But during these wind events, it's kind of neat to watch and see where all the outages are in Indiana compared to where we're at. It's made I wish I could quantify it. Let's just put it that way. It's a tremendous difference that tree trimming has done for us.
So when Earl was commenting about our maintenance costs going down from 22 to 23, in one respect you go, that's good. In another respect, you go, maybe it's not so good.
It impacted us by about 8 months.
It has an effect that I think, again, to try to quantify it, I think we're seeing benefits of what we've done.
Yep. It's a hard pill to swallow, but I think it pays itself off.
On all the.
Yeah.
You can't always have to be able to say it.
I've had another really bad rash of ash tree. I mean, we've got a lot of tree tickets coming in. 99% of them are ash trees. So they're
All
not.
the ash is dead.
Yeah. Well,
How close are we?
Yeah, within 5 years, almost every ash tree in Baker County.
Does the emerald ash borer have a cousin that's another species?
There are other bugs out there.
Anything like that?
There's an Asian longhorn beetle that's matty that if we get it, it'll be bad next.
And I didn't know if they had a cousin that was twice removed on their mom's.
Just be careful whenever you ship a pallet from China. That's all I have to say.
All right. Okay, so Matt will let you give us an update on the financials.
From a balance sheet standpoint, there's at the bottom, there's no variances greater than 5% and or $250,000. So we're pretty close in line with budget. The biggest thing I would notice here is we did our utility plant went up 187,000. So we're getting the plant in the ground and getting the invoices for it right as much as anything. So that I think is probably the biggest thing on this one that I'd focus on. Everything else is kind of the regular fluctuations on a month-to-month basis. Next, on our statement of operations, we've got A and B. We do have variances greater than 5% and 250,000. Our operating revenue and our power costs are both above budget, mainly due to January being super, super cold there for about 2 solid weeks. We still are ahead there. Everything else is relatively stable. That's really the main thing that we're looking at. It those, as it says here, our KWH sales are still 3 million KWH above budgets. I mean, we used a lot of power in January. Cash flow, in general, cash is up a little bit for the month, not a huge amount. Nothing really wildly different there. That's what I would say. That's just standard timing of bills being paid, and how things flow through. It's within what I would consider a reasonable range. Any questions on any of those?
we can talk about 90-day accounts receivable quick.
Sure.
Sorry, back to yes. So the last 2 years has been pretty consistent. And this year it's a little bit more. Is that, do you have any pulse for that?
So this goes back to our AR best. No, I did notice it, but I don't know, Jason, that we still
It's been really consistent. Just seems kind of odd.
See, I think I probably answered.
It's our company metrics. I noticed that it's interesting because you can.
No, I think I know what that is. That is it jumped a huge amount in that our instruction that the check got lost in the mail.
January and February.
Close from the time they initially created the invoice.
It might be. Your 30 and 60 is right where it should be. And 90 has a big jump the last 2 months.
Let us look into it. I'm gonna take an action.
I'm not sure. I didn't.
Just curious.
I noticed it when I put this together. I saw it looked weird. It's hard to tell the exact.
No, we'll dig into it.
How that would,
I don't think so either, because
No,
it could show up in the 60.
yeah, that'd be, that's not it.
It's on.
Yeah, we got it's
It may not be that.
Yeah, I don't know. Like you said, it's $1,000. I don't know. I didn't look at that. I'll look at it. It's curious.
We'll take an extra. Because it's not, if you go back and look at the 30 and 60, it doesn't really.
No, they're good. Like, they're actually lower.
My guess is it's probably like one instance of something.
But you'd have to be a pretty big instance. After that much.
It's only
Well, it's worth
less than
$4,000. 3 or 4 grand. Yeah. It's
I
basically.
mean, look at the scale. That's what it looked like to me too, or maybe even less. We'll dig into it. It's a good question. Just jump to your plan.
Yep. Go back one. Sorry, you have the plan investment details. You can put that in there. But you guys have that in your call to order. Biggest thing I wanted to note there, we purchased 70 transformers. They're 15 and 25 kVA. So they're not super huge amount of money, but that should be all the small transformers we were going to buy for the year. They came earlier than expected. So I do think some of the supply chain stuff is starting to alleviate, but we have them. We should be good to go there the rest of the year. There'll be big transformers we buy in as bigger projects hit off and some of the stuff we've been waiting on. But in general, the small stuff, we should be good to go. And then in general, from that's probably the biggest thing from a plant standpoint that happened this past month. The work order closed, 23 poles, that's normal. Purchased 100 meters there on, we get a pallets full of them or none. I mean, it's usually you either get a bunch of them or zero. So.
It has been a little interesting on our distribution work plan projects. So all of our work plan projects this year were really based around old infrastructure that we are moving to more accessible. And it's been incredibly difficult to get right-of-way easements. So we thought these would be like home runs where we're moving them out of people's yards, woods and things like that. We're moving closer to the road.
Be like poles run through the middle of your field and people are not sure they want them next to the road. Doesn't make a whole lot of sense.
It doesn't make a whole lot of sense, but it's been interesting. Like Brent has struggled getting some easements on things that we thought were just home runs. Like we've had people tell us, we've been mowing around these for 30, 50 years, whatever years. Like I'm fine where they're at. It's like, well, so it's been interesting. I think we're fine. We're going to get the projects we have done. Got an early jump on them. There's only 6. But it has been interesting, I would say. We have a whiteboard meeting every week and we talk about the 6 projects. It's interesting to hear Brent talk about.
What you're saving on them, I got one right in the middle of the drive. He got hit about, what, 2 years ago, 3 years ago, something like that. Sure look at that thing.
Next. The reason the one's negative is we got a large 8 construction. That's the big project that's getting ready to go off out of Westport Sub. So we got a large 8 construction. So that's why that would be odd. Everything else is, I mean, I would argue pretty much standard and normal. So that would be the only one I'd draw your attention to that wouldn't look right. And that's why it's because it's 8 construction. So.
Everything's steady Eddie, honestly, from
Yeah.
a financial standpoint and from just getting the work done.
The contractors are making good progress out there too on redoing the double circuit line. And
I don't know if everybody saw or not, it's on Facebook, but our AES is the company that we use for full testing. They're doing New Point this year. And so if you get asked, hey, they'll have a Decatur County RMC magnet on the side of the truck, but it'll say AES. And then they'll have a 4-wheeler. Usually we have with that wire there.
Is that IPLAES?
No. They're I don't know exactly where they're at. They do our pull testing.
that's because they have like a.
No, he's an independent one.
Oh.
Typically, we get,
Sign yet.
they may not have had it on, but they're supposed to. Yeah. Where we normally get calls is he uses a four-wheeler. They'll park their truck and then so normally we get a phone call that says, hey, do you guys, who's out on a four-wheeler? That's who it is. So we put it in the magazine, we put it on Facebook, and it's on the website. So we're trying to communicate that this is normal. Although they started, the whole idea is trying to get them started early in the year so that if our guys free up towards the end of the year, they could start replacing the ones that are rejected. So that was kind of the goal. And so
Instead of getting the data in October, hope to have the data by August or July, August, and then we'll be able to better plan for next year. And if we do get ahead, they can replace stuff in November. So that way we're always have stuff in the funnel to go to the back. Hopefully they don't find as many poles back there as they did some of the other places.
Anyone have any questions? Matt, financials? All right, thanks, Matt. We'll head on toward new business then. And Brett, I think you're going to talk a little bit
Yep.
about that.
So as most folks know, our wholesale power costs have increased over the past 2 years. It's really been reflected in the tracker. So you see our tracker is about 16 cents per megawatt, which is about 1.6 cents. That has gone, ideally it's at zero. It's been negative before. 1.6 is pretty high, and it's been that way for over the last 2 years. It's primarily due to the increase in power supply and transmission costs. So what do I mean by increase in power supply? Gas is up 30% since our last rate design. And when I say gas, if you go look at the gas future, or if you look at the gas actual cost right now, it's not up 30%. It's the futures. So when Hoosier does a cost of service study, they're always looking ahead instead of behind, right? So, which is a little different than the way we do it. So looking ahead, if you look at the futures for gas, it's 30% higher estimates through ACES than it was when we did the rate base back in 2001. I think it was last time Hoosier did their rates. So 30% there. Market price is up. That's primarily due to other folks having gas and coal increases. It's up about 40%. So just spot buys on the market through our other PPAs is up 40%. Solar capacity, and Jason, I'm sure can speak to this, but if you look at the projects that have gone off or have not gone off, which is more or less what's happening, solar capacity right now is about 75% increased cost over the last 2 years. So the cost is going really, really high. And then on the transmission side, it's the same old story. We have an aged infrastructure across the United States. Everyone, not just Hoosier, is investing pretty big dollars in investments in transmission. And then MISO wheeling charges have increased year over year quite a bit too. So those are the things that are really driving our wholesale power costs to where it is today. So if you think back, 2015, 16, 17, it was pretty steady at about $75 per megawatt. So that's 7.5 cents. Then we got into where we did the Miram. Miram was sold. It went down to 71. And then it jumped back up to 86 during COVID and to 2023, just because of all the things that were going on. The forecast right now, so where we're sitting in 2024 is 85, 84-ish. And what they're projecting for 28 is 84. So pretty steady Eddie, but higher than what it was back in 16, 17-ish. So the reason I tell you that is because with the tracker being that high, what that tells you is that the base rates need to change, right? So not necessarily a rate increase. It's the buckets for energy demand are probably off, and then they want to take the tracker and zero it out. So ideally you would zero the tracker, and whatever cost that 1.6 cents is, it goes into energy demand. So there's going to be this cost of service study that they're working on right now. And my guess is there's going to be some shifts in energy demand to our bill.
So what that means is we're gonna have to look at a cost of service study. So here's my proposal. So we know the Hoosier timeline is they're doing the cost of service study this year. They'll have board considerations and recommendations to change in November of this year, which means we can start anytime after November with the idea that April 2026 is when they're going to put in place the new rates. So that's the timeline. So what my proposal would be is June. I know that Steve has cost of service study training that he wants to get done and needs to get done. And I can tell you that the first time you hear cost of service study training, it's going to be like, it's not going to make any sense, right? So you need to hear it 2 or 3 times. So my proposal is the end of June, I will offer a cost of service study training here. I'll use the same slides we've used in training in the past. That way Steve can get it, and if we happen to get a new board member, they can get it. It'll be a very high level, probably hour or 2 hours long. Matt and I can kind of hit it together, go through the slides. I would invite all board members to that end of June. And then we will start the bidding process close to October, November-ish, when we'll send out some bids to do our cost of service study with the idea that November, Jason's going to be voting on the Hoosier rate. In December, I would hope that we would want to select who we're going to go with and kick off a training in December with whoever we decide to go with, right? So an in-depth training in December. And then we actually kick the cost of service study off in January of 2025 with the idea that we want to be done with rates. We basically have all 2025 to do the cost of service study, figure out what we want to do with rates, if anything, and then have it ready to go for April 2026. So that's my proposal. I just want to get it out there. I don't know that we need any decisions other than if that sounds okay or not.
I think it's a good approach. It's not really going to change. I mean, at the end of the day, ideally, it's probably not going to change what everyone's paying. It's just going to take that money out of the tracker.
And literally for residential, as long as Hoosier doesn't do a rate increase, which is not the likelihood, residential won't even change, other than we're going to want to, we'll move the tracker from the tracker to the base rate, but when they look at their bill, they're not going to know the difference because the total is going to be the same. Where it'll be impacted is in our industry and commercial, because there'll be some switching in energy and demand. So we'll have to decide, is it enough that it's impactful enough for us to make a change or not? The answer may be no, but we won't know until we get it. So I don't suspect a rate increase. I suspect it's going to be a rate rebalancing. But when you look at commercial and you start messing with energy and demand, some people are going to get a rate decrease, some are going to get a rate increase, small amounts, but that's what happens when you change energy and demand. So that's where we're at.
Okay.
Did I miss anything?
We'll still have a tracker. A tracker will still be a function of the rate design, but it'll be 0 again.
Figure out how to get this. Okay. I had all these slides up. Okay, so I think we've had this conversation before, but I'm going to try to do a little bit better job of presenting this. So here we go. So we are going to be doing this culture transformation, and I can tell you as a part of the culture transformation, I think it's very, very important for us to set a vision. I have an idea of what I want and what I vision where we're going. And I don't know that you guys need to vote on this, but if I'm going the wrong direction, now's the time to tell me, because I'm planning on presenting this to the company. And I can tell you that one thing I've heard over the last 6 years I've been here is, Brett, where are we going? Brett, what are we doing? Like, what's the consistent message? Where are we heading?
What do you expect this place to look like? What are we doing? Right? So there's a lot of confusion and I understand that. So I think it's time that while we do a culture reset, which I am ultra excited for, and I think my entire leadership team worked all last year on this. But at the same time, I think it's time that we throw out a vision. All I'm looking for is directionally, are you guys okay with this? Because this is what I'm going to be pitching to the rest of the employees, and there's a plan behind it next week. So we probably ask why. Why do we need to do a vision, Brett? And the reason is because I really want to change the business here, right? We are a very reactive business. We don't do a lot of business planning. It's a very reactive, that's just how we're structured. That's just how we are. And it shows. If you see our project execution, it's not great. We hit 50% of our projects. Quite honestly, 50% to me is not where I want to be. So you go back and you root cause that and you're like, well, why? And it's because the business isn't set up to be able to do projects and things. We're really good at fighting fires. We're looking at what's up today. I had a member that called me today. We're really good and we have a very good team. Yeah. So we're looking right in front of us. We're really good at putting out fires. But I want to change that as far as vision. So let's see if this works. So I believe we have a very high performing, a very competent workforce. I am very proud of where my leadership team is at. And I can tell you out back, we have an excellent team. And in my opinion, I want to get away from putting out fires and get closer to moving some mountains here. I believe we have the skill set. We have the team. I want to start moving some mountains instead of putting out fires. I want to start looking ahead. So that's the why. This is the part that I missed, I think, last time I talked to vision with you guys is, as a CEO, it's my job to inspire the mission. Well, what is the mission, right? The mission is what do we do, right? What are we here for? What do we do? While I'm inspiring the mission, I'm also casting a vision, right? So, and the vision is where are we going? We know what the mission is, right? But where are we heading? That's the vision. Then it's my job to implement a strategy to how we get to that vision. All right. So how do we get there? That's a strategy. Then we have goals. So I want all of this to flow down to where Matt's goals are the milestones along the way. Right. So you have a strategy. That's how you get to your mission. And we have milestones along the way, which are our goals. And then, of course, you can have all this mission, vision, strategy, and goal stuff. And if you don't have a culture or the people, you're not going to survive, right? Or you're not going to execute at the highest performance. So what I see is a world-class culture and people. So we know what our mission is, and it's what we do. We exist to provide safe, reliable, affordable, friendly service to our members and community. I would argue at some point that needs to change. I believe, Brett Plant believes our mission should be, we're here to do what our members want us to do. Obviously, it would be different words than that, but essentially, I like the idea of we are here for our members. What the majority of them want us to do is what we ought to be looking into. I'm not worried about that right now. I think this is fine. It's fine. So we know what the mission is. It's that. So the vision, again, the vision is where are we going? I'm proposing, and this is a little wordy, and I'm going to explain it a little bit better, but I want to achieve a championship level performance, right? Ultimately. Right now we're putting out fires. We're doing a good job of putting out fires, but we're not doing a whole lot of, hey, is the generator program going to work? Hey, we're not moving mountains, right? We're just doing what's in front of us. I want to do that through the strength of our championship team. I truly believe we have the right people in the right spots. That's why it's going to take us a while for the operation manager, because I want a championship team and I'm not willing to sacrifice that. And I believe after we get through this culture thing, we're going to have a world-class culture. So that's my vision. That's where I want to head. And I'm going to explain this a little bit more, but basically what it means is I want to get away from just firefighting and I want to move mountains. So I'm going to explain a little bit more about the vision. There's the mission, there's the vision. So next is the strategy. How do we achieve championship level performance? Some people could call it best in class. I like championship level, right? How do we get there? That's your strategy. So how are we going to get there? How are we going to get what Brett says is a championship level performance? One of it is through operation, and this is high level, operational excellence, right? I believe to move mountains, and I'm going to put this in words and context, maybe we don't do well at executing projects. We don't even have people to work projects. I get people that call me all the time and say, are you doing that generator program? I don't know. We don't have anybody to work on it. We're working on what's in front of us today, right? We're really good at what's the problem that's in front of us today. So in order to have resources and things, I believe we got to get to this operational excellence, right? So we need to gain some efficiencies. The second thing you're going to have to do, you could do this one or two ways. You could say, we're just going to add headcount, right? I don't believe that's the best way to do it. I believe you work on these efficiencies and then you look at resource allocation, which could be headcount, which we've already done. You guys have seen, we've added heads, right? Now we got to make sure our org chart is set properly and we're taking advantage of each position. That's what I call resource allocation. So it could be more headcount. I think we've already added quite a few heads since I've been here. So we're already heading in this direction. Continuous focus on employees. We've spent a lot of time and effort in career development and career path planning for our employees. We got to continue that and keep that going. And then continue through this culture transformation, which we started last year with my leadership team. So a little bit more on strategy. I'm going to break down the operational excellence in that. So what we find if you can harmonize member value with employees' goals, and I'll give you an example here, with employees' goals and compensation, everybody feels valued, respected, and heard, right? This is part of how do we make sure that everyone that's doing a job, they know how that impacts the members. So the value stream to the members, and there's a KPI, and they have what good looks like. Every day they're doing something. They know what good looks like, how it impacts the members, and how they are compensated and what their goals are, right? An example would be one of Sam's duties to our members is to make sure that he keeps members' information secure. That's the value of IT, one value of IT to our members. So let's measure that. Let's put a KPI on it. Let's make everyone else have a KPI on it so that we're all striving to, and we can see what the value is to the members in our daily jobs. KPI is a key indicator, essentially. It's a metric. Operational excellence. This is business planning, KPIs, good question, and visual management. We've started some visual management back with our whiteboard process. I foresee us having one big wall that has every department on it. KPIs that they can make decisions daily on, not just these equity number, right? But things that we can make daily decisions on, and managers can have daily startup meetings with their folks, and I can jump around to those, and I can look at the wall and know exactly where our trouble spots are at and where my attention needs to go and how we manage and make decisions daily to be efficient. This is all around efficiency. Another example would be, let's just say a crew doesn't go out till 10 o'clock in the morning and they're coming back at 2. Well, why? Because we're not really managing it. I mean, if somebody's not paying attention, no one's going to know that. There's no metric sitting up there that says uptime for the day. What's our goal for tomorrow? What are we doing today, right? How do we maximize that? Those conversations aren't happening. That's not how the business is set up. We're set up to look at the firefighting for today. So that's what this does. So how are we going to do that operational excellence and harmonize our member? I'm going to utilize, just like I told you guys, the Toyota Kaizen work. We're going to create these visual managements. We're going to start with the work order and service order to where anyone in the business can go over and look at where's all of our service and work orders, right? And then they'll be trended on this line. And if it's in the red, that means something's going on. Somebody needs to ask some questions. We can quickly look at a board and know where the issues are at, right? Plus, now you can start to plan it a little bit better so we can actually sit on the desk. Here's your work orders for the day. Tomorrow, here's what that is, right? We don't do that. Then NISC work. So work management, something that we put in the budget. It's later this year. We want to get this where we want it to be, right? So the process looks good so that when we do work management, which work management gets rid of papers. Instead of us saying, here's a work order, go do it. It's all in the computer, right? And it's a value stream driven process in the computer. Mobile staking, we're looking at doing that in 2022. That's where we get rid of papers altogether. He's going to go out with his iPad. He's going to stake the job. It's got GPS tracking. He can get a point here. He can get a point here. He can measure here. It all gets put in the system and it all generates itself. It'll send a work order out through our iPads to our guys out back. They'll be working off iPads to complete their work orders essentially. And then long term, what we're planning on right now, it's probably going to take between 10 and 15 days to have our Toyota contractor come in. They're going to sit down with every department and they're going to figure out what are the values that, like I told you, one of Sam's values as an IT is to keep members' information secure. Every single department has value stream straight to the member. In other words, what their work does every day, it impacts a member a certain way, right? Otherwise you wouldn't have those departments. So we're going to figure out what are those values. And then they're going to do this KPI tree, which is going to go down and it's going to develop what are our measurable things that we can make decisions on every day. And then we're going to have this visual management and then we're going to have business planning. Resource allocation, this is headcount of org structure. This is just going to be an ongoing thing. Quite honestly, I've been working on this for 3 or 4 years, trying to get heads where we need them and job duties under the right people. It's all about trying to be efficient with the talent we have. May or may not be headcount. It may just be some work structures. Culture transformation, we're already working on that starting next Tuesday. I talked about continuing employee and development. And then we're going to end on, Jason wants to know where his projects out on the right of way, right? What we're going to do is all of those projects that we created in our last strategic process, they've been sitting on the backlog. Well, why? Because we're getting phone calls and we got to take care of member stuff. We're firefighting. We don't have time to do all that stuff, right? And it's not just because we're not efficient. It's because we don't have KPIs. We're not tracking this stuff. I don't know who's open, who has allocation, who can do this. None of that stuff's in front of us. So this is all hoping to get to the point where, like this year, we're going to prioritize all those things. And then we're going to execute those really high value ones, the ones like generator program. We're going to do a generator program. We're not going to do a program. RF metering. Do we need to do that? Is it feasible or are we going to do it or not? Right? The right of way thing. Are we going to do it or are we going to not do it? So that's essentially where I'm at. I guess what I'm really asking is there questions? Do you guys agree with the statement on vision? Do you agree where we're going? I'll be quite honest, I've been heading this direction for a couple of years now. I mean, the head count that you've seen me ask for and the org changes that we've done, it's setting us up for this. So this is the direction I've been going, but I'd like us all to be somewhat on the same page because this is all we're going to be talking about from a staff standpoint, because I have been asked for 6 years, where are we heading? Well, now we know where we're heading. We're going to go move mountains. We're done with the firefighting. We're going to have firefighting. That's going to happen, right? There's no way to get rid of that completely. But I want to do firefighting and then go move mountains. I think we have, you look at some of these bigger co-ops, Jason sees it. You see it when we travel and we see some of these things these other co-ops are doing. And yeah, they're bigger co-ops. That's not an excuse. There's things that we can be doing for our members that today I don't believe we're doing that I want to do. Our staff wants. It's just, we're not set up that way. We're set up and we're really good at fighting fires and solving problems on a daily basis. But I want to set up our business to where we're efficient. We have people where they need to be and we leverage. I'm telling you, we got a lot of talent sitting around here. And I want to go move mountains. I want to do some things for our members that, this generator thing shouldn't be that hard, but we're just not set up to do those types of things. So that's where I'm at. I'll go back to maybe see it. Vision. Yeah, right there.
we talked about the vision here, what, 3 or 4 months ago, and I'd really like the board to consider that we approve this vision. As we talk about it, certainly something you can work with what you have here, but I think the board needs to be committed as well with an approval of a vision.
Yeah, and again, if you want my really quick, how do you pare that down? It really just means I want to be champion. I want a championship performance. I want to move mountains, right? And I want to utilize the championship team. So we're going to work on our team, keep working on our team, keep working on our team. We had a very young guy in the back put in for operations. Why don't we have a plan in place for him? Why aren't we providing for him to get him to that level? We owe that. We need to do that. And then this world-class culture. The world-class culture is driven by the fact that I want everybody's quality of workplace to be very, very high. People's expectations are different than they were 20 years ago. I want everybody to want to come to work and be excited when they're here, right? And that's where I'm heading with our culture. That's what the whole transformation thing is about. It's about also being, when I got here, we moved from not being really a siloed organization, which isn't always a bad thing. I'm not saying that, but kind of a siloed thing to swung it way over and we're going to be collaborative. Everybody's voice matters, right? Well, it's time to dial that back a bit. Your voice matters only if you engage properly, right? So that's part of the culture transformation. That's what my team, we've, and Matt, speak up if you want, but we've worked really, really hard last year we've had some difficult conversations. We've sat down and made agreements. We're now living by those. We talked about some of the shop play stuff not that long ago, right? That stuff's already starting to go away. We haven't even started the reset date, which is next Tuesday. So I'll be quiet and listen.
How do you get buy-in? And what happens if you don't get buy-in?
So how do I get buy-in? I'm going to get buy-in by being very, very passionate about explaining this, answering questions, and being very deliberate. I got 2 answers for you. Being very deliberate in all of our conversations. This is where we're going. This is why we're doing that. This is why we're doing that. Every time we meet with all employees, this is why. This is why. They want this vision statement. They've been asking for 6 years. Brett, where are you going? Where are you going? Right? So the other part of getting the buy-in, in my opinion, is they're going to be a part of creating all this. And the only reason I haven't gotten this done is because I don't have time on my own to do it. And time and expertise when it comes to facilitating Kaizen type work, setting up these processes, really understanding how to do visual management. We have no visual management. We have one. We have whiteboard that we introduced 2 years ago, right? Why don't we have that? That's how you manage people. That's how you manage the work that's coming out of the place efficiently. So my second answer to that question is that's why we're using Toyota and a consultant. It's because they're going to help us get there. They're going to do it by working with our employees to develop some of this stuff. So he's not going to be developing, here's the values of your department and the KPIs, the strategy that you're using in the visual management. So your manager can look at it in 5 seconds and tell what things need attention. He's going to be working with everybody in the department to come up with that stuff. So there's going to be some ownership because we have a facilitator that has the expertise that's going to come in and help us get there. Does that help? But I can tell you people are, from the last 3 years that I've seen here, people are starving. Employees are starving for this type of stuff. They are. They want a culture change. People don't want a stagnant culture. They want this. They're excited that we're going to hold people.
There is an appetite for some change from majority of people. I would say. No, I'm not going to say that everybody is going to be on board because that's.
Our saying at the leadership level has been, we're going to invite you employees in. This is an invitation in. I can't make you drink the Kool-Aid, but you can't stand up on the table and pour the Kool-Aid all over everybody. You're going to have to If you don't want to drink it, that's fine. Don't disrupt us that do. And I'll be quite honest, we've talked to some of the most hard-headed people here, and they've kind of committed to, I'm not going to be a cheerleader for this. I'm not going to be the guy, pouring the Kool-Aid out, but I will definitely, sit in line. I mean, I will definitely not disrupt. I mean, we've heard that.
Said that they said they won't dump it on the table.
Yeah. So I'm encouraged by this all, and I know it just sounds like a bunch of words, but this isn't a bunch of words. There's dollars, lots of dollars in this stuff to get here. This isn't something you just do overnight. There are, that vision creates the plan that I have below, that a lot of dollars and time are going to be invested. There already is a lot of dollars and time invested. We've been working towards this way for a couple of years. I just want to finalize it so that our employees know where we're heading. And I think, I'll be quite honest, I think they're going to like it. I do. I think people, once they get involved in the process and there's nothing better than, I'll give you another example. Today, we have no idea besides the ACSI, which is measured once every other year, what our members think about us. Why don't we have surveys that go out, just like any other company, that go out every time you have an engagement? So you're not going to get everybody to do it, but some you will, right? We will have daily information on what our members think about us that are engaging with us. What would be if you're an employee and you're busting your tail today and you really work hard. Carl called in and he has a need, and man, I'm busting my tail to meet his need. And he comes back with a survey that recognizes me, right? And it recognizes the department and a score that's very, very high. And Crystal's getting the group together in the morning for a morning startup. And look what your work did for the company. Oh, and by the way, your compensation is going to go along with that. That's how your goals are going to be set up. There's nothing better than having a company set up like that. I'm telling you, I've seen them happen. That's part of the goal here. Again, the other part of the goal here is to be able to manage the work so that there's some accountability too. We're going to be asking for more work out of people. There's no doubt about it. I foresee us having a metric of, we measure this from our times. We know what unproductive work is time-wise from our operations group, and the difference between what's in a work order and unproductive time, we know what that is. So let's measure it. Let's put it on the wall. Let's have a plan to make sure that every day, go look at manufacturing. You get on a line and it says our goal is 56 widgets today, right? That's good. And we're going to measure it every hour. We're 36 widgets. We're 56. Today we missed it. Tomorrow we come in, we're going to hit 53 widgets, whatever. Right? That's where we want to go with this. It's going to hold people accountable. It's going to get us really, really efficient. It's going to force us to have the conversations that we ought to be having, which ultimately all those things are going to get us to move mountains instead of just firefighting. That's the goal.
My only concern is like resource allocation, headcount, org chart. If we set that up now and 3 months from now, we're doing a fiber project, is that going to blow that all out of the water?
All this is gone if we do a fiber project. And we've been very, very clear with that when we've done all the culture stuff. We're still going to go forward with, right? But I can tell you right now that the org chart will have to change majorly if we're going to do a major fiber project. So none of this is fast. I think we'll know a lot of those answers, and a lot of this has already been going on. I mean, I have changed the org chart and we've added heads since I've been here. So I mean, we're already. This isn't going to be like Brett's going to come in here and ask you guys for 10 more heads. That's not what this is, right? It's going to it might be one, it might be two, it might be shifting some jobs around, might be doing some of that type of stuff, but it's not going to be anything that we go to, I think, is salvageable if we would happen to do a fiber project. But I will tell you that this is going to get not thrown out the door. It's going to get shelved if we go fiber, for sure.
I don't know if it's worth waiting 3 months. See, or you.
This will take us 3 months to start even.
Okay. So
and quite honestly, I'll be quite honest, we've been doing a lot. Besides Toyota coming in and helping us, we've been doing all this stuff year over year. We're just not making enough headway and I don't have enough open allocation. My team doesn't have enough open allocation to do the things that I think Toyota's is going to be able to help us do to get it set to where now we can operate the business different. I've been talking about this same thing since, I mean, I talked about this in the interview and I will. I think Steve was the only one that was in the room. One of the reasons the board hired me was because, and Steve, you can possibly speak about this too, but one of the reasons is because of my background, right? And the fact that I have had experience doing this stuff and I've seen things like this. And I know this will, I always say, have you ever seen an operation where it runs like a well-oiled machine? Like, you know, we're not fighting fires every day. We're actually planning stuff out. We know what we're kind of, could you imagine, in my opinion, if we do this really well, there probably isn't going to be a budgeting cycle because you all are going to approve plans. And this plan's going to say, this is what we're doing. Matt's going to laugh at me here because he hates these times. But in a perfect world, there really doesn't have to be okay, here's our plan for next year, right? You have a 10-year plan, you have a 5-year plan, and then we know what we're doing. And yeah, there's probably a like sign off of the yearly budget, but it's not you all are already going to know what's in it because we're planning that far ahead. That's a long way out. I'm just saying that ideally is what this gets you to, is you have a business. I mean, Hoosier does this every day. They have a business plan. They know what they're doing 5 years out. They can predict their rates 5 years out because they know every component of their expenses going into it. I mean, we've got the chart right here. They can't tell you what their rates are they can tell you what their rates are because they know all the expenses. They know what they're doing. Oh, this goes out to 2028. They know what they're doing. They have business plans. We could estimate it maybe.
Can I make some comments?
Sure, go ahead.
I'm kind of just going to agree with a little bit of everybody, but also on my own. I do think everyone needs to buy in, or it's a waste of time, money, and resources to even begin it. We do surveys for everything else. Is it possible to do just a free monkey survey to find out truly what the employees are starting for and what direction they feel like some of these resources need to be going to? And also, before Toyota or any other industry comes in to revamp or redo, the fiber project is going to change the whole scheme of the REMC. And I feel like nothing should be done until that is finalized or not, whether it's 3 months or 4 months or 5 months. I'm not disagreeing with it, but I feel like that fiber project is going to change the whole atmosphere of that, including staff. So I feel like nothing should be really moved forward in an aggressive motion until that's finalized.
Yeah, Suzanne, I should have probably been a little bit clearer. So the time plan on all this is they're coming in the 9th and the 10th, and that is only to work on the operations, the work that we have to get done in order to do work management in NISC. So that, regardless of fiber, has to get done. We will not bring them back until, I think the first opportunity was like July timeframe. So by then we're going to know a lot more about fiber. But I totally agree. We're not going to invest a bunch of money in Toyota to do any of this work until we kind of know what's going on. The only money that we're going to be spending is the thing that we already have to do. I mean,
You've already started it.
well, not just that, but this has to be done regardless of fiber. I should have made that point earlier. As far as the employees and they were all part of the last strategic planning. What I will tell you is the whole culture stuff. It's all driven from metrics from our employee surveys. So I guess what I'm saying is I already have that data. That's what drove a lot of this. The whole culture thing was driven from, and I actually have that on a slide I can show you. This is why we're doing the culture thing. It's all driven from employees. These are the employee survey results. It's stagnant. We made this huge, when I got here, we moved left. Now it's just kind of came down and it's stagnant. So this is all of our culture work is being driven
primarily from employees.
Make a couple or a few comments. I think the impact of culture is incredible, and it's hard to quantify what you can do. Regarding the comments Suzanne just made, I don't think you'll get 100% buy-in, but if you get the culture in place where you want, I believe what you'll find is those that have embraced it will thrive and flourish, and those that haven't will leave.
Yeah.
And you'll replace those with additional people or other people that are inclined to say, that's an environment I want to work in. It's not going to shift from firefighting to visionary forward managing. We're not going to leave on a Friday and turn the lights off and come back on Monday and fight. I mean, there's going to be a transition period that's going to be difficult to manage.
Absolutely.
So when you're talking about the additional work, there's going to be a bunch of additional work.
Absolutely.
The benefit is long-term. The pain is going to be short-term. You're going to have to absorb that short-term. But I think it's hard to estimate the intrinsic values, because when you build that culture and you get everyone that has a buy-in, it's not two people doing twice as much work or getting twice the benefit. It's two people and you're getting 250 or 300% of the benefit. There's an intrinsic value, and you gain momentum, and it's a real intangible thing, and it's hard to quantify. But when you see it and when it happens, it's big. I don't know if you have the staff. I mean, I hear you say, and I know what I think of the staff. I don't know if you have the staff, and you may be surprised you think you have the staff. You may find out you don't. You may find out that they can outperform even what you think they're going to do.
Absolutely.
It's very much a learning process. And I think the whole vision culture thing, is that's some of the things we're trying to do at work. People need to come, in my mind, this is mine. I've always said this. A good employee wants to know what's expected of them, have the opportunity and the tools they need to meet those expectations. And then when they meet those expectations, using the tools they have, expect and should be compensated and rewarded for what they've done. It's that simple in my mind.
The number one question I get in one-on-ones, and has been this way since day one of me being here, is, where are you going, Brett? Where are we all marching to? They're not going to tell me what it should be. They're looking for me as the leader to cast a vision. Where do I want to go? Steve Jobs' employees didn't tell him where to go. He cast a vision.
So what do you need from us? I mean, just kind of.
Honestly, I don't need, I mean, I think I answered Suzanne's question, and that's a very legit,
Yes.
board question is, we will not be spending, I mean, the earliest that we're going to be able to get these guys is July anyway. So we know June, we're going to know what's going to happen with the fiber stuff. And the only thing we're doing with Toyota on the 9th and 10th is stuff that has to get done on our service work order. Quite honestly, if we do fiber, that probably needs to speed up. So that's a good point. I don't know that I need anything other than, we've been doing all this stuff for years. I'm just trying to put it on paper so I can speak the language when we're talking to employees. When people are asking me, Brett, where are we going? You know, I mean, my word is going to be, you're going to hear a lot. We're going to move mountains. We're going to do more for members than what we have. We're going to do everything we can. Bring new programs. Just because we're small doesn't mean we don't have the talent and the ability to bring members new things and projects. I mean, again, go look at our project record. All those projects you guys just approved today. Let's see if we get those executed. It's tough because you were doing the daily firefighting.
I don't think I need anything. I mean, other than if you guys completely disagree with this, I probably need to know that. Because I am going to be preaching it come Tuesday. And we'll get a level of, a level from, it'll be interesting to see what we kind of get from employees on Tuesday too. Crystal's going to help me present this. So she brings she can word things differently and it really adds a pretty good aspect to it.
Was there anyone that is in disagreement with what you just heard? Okay. All right. Thanks, Brad. The next item is talking about changes related from going from 8 districts to 7 districts. Yeah, you got to kind of give a high level. Sure.
On this, or do you want to have a different discussion?
No, go ahead.
Okay. So a couple things on this, and I wrote you guys a memo trying to describe this. So a couple things we did. Number one, as soon as we found out Clay was not running, we knew we had to try to react very, very quickly because we were trying to get out in front of the nominating committee. Well, unfortunately, 2 weeks wasn't going to be enough. So that's one. Two, originally our idea was, if you guys remember talking about redistricting, we were going to go out and find somebody to do it for us, use a computer program and have it spit it out. Chris Galloway is, I would suggest, our mapping expert, thought, but I think I can do this. Why don't you give me an opportunity? So instead of spending $6,000, and that's what it was going to, or it was actually $6,200, I think, to have someone else create these changes for us, Chris is like, let me go try it. So, all right, well, we had to get off to an early start because if Chris couldn't do it, we were going to be tight on time because this has got to be done. Obviously, prior to it would been nice to be in front of the nominating committee, but we just weren't going to get there. And then last, from the discussion we had, I believe it was in November of 2021, we put out a bunch of different options. And, the option I heard was we're going to go to seven different districts. So that's kind of why we worked this. So a couple things we did. One, the requirement was current directors need to stay in their current districts. What we didn't want to create is now Carl's in a different district. So what are we going to do in his election, or any of us? So the first requirement is keep the directors in their current districts. That was goal number one. Goal number two if you look at, and it's in call to order, but if you look at the differences in members for each of the 8 districts today, there's a pretty big difference in population, right? So our goal is let's get it as close as we possibly can when we do this. So that was goal number 2. Get the population of members as even as possible across the districts. So that was 2. 3, our other strategy is everybody that was elected, whether you're a director, nominating committee, or a trust member, they were all elected for a certain term, right? So a 3-year term, essentially. So they were elected by the members or appointed by you all for a term. So what we kind of said is it only makes sense to let them expire their term. But we have an appetite, and we've heard this from a lot of different people, and we completely support. It really, I think, disadvantages a new director that has to go find a nominating committee or a community trust member the first year they're elected. I mean, literally the first month, right? Can we, Brian, you brought this up. So is there a way that we can align that so that doesn't happen? Same thing with nominating committee. It's kind of crappy for a nominating committee member. Their first year as a nominating committee member, they got to go find a director. So the idea is now's the time to take care of that. So our proposal was let the people that were elected or appointed serve theirs out, but then have what we call a short term. So some districts will have short terms. What I mean by that is Dale's district may only have a nominating committee the next go around for 1 year or 2 years, or it unchanged at 3.
The reason we did that was to align it to where the nominating committee member, the director, and the community trust, their elections were all on the same year. That way, they're not forced to go find each other the first year that they're elected. That's the whole goal of it. So that was the strategy that we tried to do going into this. And so he has a computer program where he can drag lines around and basically he was trying to keep everyone in the districts. And in general, we were able to do that. The only ones that we weren't was there are some nominating committee members, and you can see that they're on there, where we had to make some exemptions, I guess is the word. So those would need to be wrote into the bylaws along with the short term needs to be wrote into the bylaws with the idea that once we get through this short term, everyone for the future will be on the same. There'll be 7 districts and everyone will be on the same thing. So what we did, so then he took all that information. We worked quite a few times through our leadership team, trying to get the districts and the map to the way we wanted it. And then Chris took a shot at doing the red lines for the bylaws, and there's community trust bylaws too. So there's 2 sets of bylaws affected here. So he took a shot at redlining those. So legal has approved both of the 2 documents that you see in there today. So we've already basically went through a legal review of what these would look like from a standpoint of red lines. So again, those were our strategies and kind of how we tried to get to what the new districts would look like. I would like to acknowledge Chris Galloway did a phenomenal job. In fact, when we took these to legal, it literally took them like an hour review and they had very, very few changes. And so he did a bang up job. And I think our leadership kind of also said the same thing. So.
Yeah, you had multiple parameters. It was make sure the director stays in the same district, keep as many nominating committee people in the same district as possible. Anybody who's already been nominated has to stay in the district they were nominated in.
Yeah.
And try to even it up as much as possible. And on top of that, to keep it as square as possible. To make it not have the snake.
And so remember, even the director candidates for this year, we had to make sure that if they won, they were in the same district. Because we tried to get out in front of the nominating committee to show them the new maps and say, hey, please follow these new maps. Because to me, unacceptable was someone goes out and finds a director to run, and then we go back and say, sorry, you're no longer in that district, you can't run. That's not fair. That would be horrible. So we wanted to eliminate that. So quite honestly, where the lines ended up going, there ain't a whole lot of change you can do. Because if you all agree that candidates and current directors need to stay in their districts, we had to actually make some squiggle lines to make sure that happened. But in general, I can bring up the map. This is going to be really hard to show.
But it's in the iPad.
It's on your iPad too.
It's pretty easy.
But I mean, you can see, the colors aren't coming up here. You guys are going to have to look on your iPads. The color coding is the old districts. And then the outlines are the new districts. So you can see some grew, some shrunk, some all grew. They all grew, obviously, but it moved around a little bit. But I was impressed in how close Chris got the members. I mean, they're way closer than what they are today. And that's in your call order too, as far as
mean, it's pretty much, don't move anybody, get it as even as possible. Don't move any directors out of where they are, get it as even as possible, and make sure that anybody who's already agreed to run stays where they had agreed to run. And
So you can see through here, we swung from 988 down to 637. Now we swing from 785 to 1,000.
And the biggest issue there was the two people that had already agreed to run. You had to, there was no way to keep a square after you had the candidates without.
Again. So I mean, I thought that was pretty darn good. I was really surprised we got it that close. And it does make it a little bit easier that, I think it would be even tougher if our voting was by district. In other words, only the people in your district can vote. This would have been a hell of a lot tougher at that point, because now it's like, but we don't do that. That's one benefit of having everyone can vote for every district. It doesn't really matter, right?
What additional work will need to be done once we determine what maps we go with? In other words, is each member have a district assigned to them now, or somebody would have to go in and modify that?
Yeah, but it can be math done. It's not.
So that wouldn't be a major issue.
We could do that probably in 2 weeks. You mean in our system, identify who is.
Right.
Yeah. Bulk of the work has been,
Right.
Like I said.
By doing this.
yeah.
And keeping everything kind of in sync. What's everybody's thoughts?
I'm fine with the maps. I like the maps. I absolutely hate the cycle of elections. I cannot stand having, you're finding 5 people out of one district in a year. I don't know. I don't like that at all, but it's just me.
You mean the current way it is today, or?
The way you have it, the proposed way, you're finding 5 people out of one district to do something in that 1 year.
Yeah, it's gonna be that.
And you're competing against the nominating committee person to find nominating committee candidates.
You have to have 2 for nominating, 2 for director, and 1 community, right?
Yeah.
That's the 5.
Yeah. That's the only way we found, though, Brian, to get, see, here's the cycle work that we did.
Well, the other thing you could do is, if it was 1 year, you could always shift it to 4 year. Then you would
You could do that.
save yourself some time.
Instead of creating a short year, you could add that year onto the next election cycle.
Well, I just like the nominating committee person and the director being different years. That way you're not competing against the nominating committee person. Find candidates. I'm not calling the same person. I'm not calling Dale and then the nominating person is calling Dale. Hey, will you be on the run for board? I'm saying, hey, will you run for nominating committee? He's going, oh, well, I'd rather.
I called Jeff Evans to be on the nominating committee, and he's running for director.
I can say that happens
Yeah.
today. I know that happens.
I'd like to offset that.
And it happened with Jerry St. John 3 years ago.
What you're saying is have the director election, then the nominating, then the trust.
Following, but the trust is,
Trust is not that big a deal.
Because it's appointed.
Trust is an appointment, yeah, it's different. But
yeah, I don't like the director. and
Brian's point, I know how difficult, the difficulties I've had in nominating committee.
So won't we run into that same issue, though, if the director and the nominating committee person aren't on the same year? Well, no, you might be able to offset it that 1 year.
So you can offset a year.
So if you offset them by 1 year, then that still keeps us, because the whole idea here was we didn't want a director to have to find a nominating committee. And we didn't want a nominating committee to go have to find a director in their first year.
Mhm.
But I think you could offset it now because there's 3 years.
Yeah, the way Carl's
The
is
second year, one would be a thing.
because Carl was it, and then a year later was the nominating committee person, right?
We could try to do that. I mean, we could try to set it up. I mean, it's basically using this, but it's gonna change everything.
You shouldn't change your maps, it'll just change the,
Absolutely.
The timeframe for somebody.
All the
being-
red lines in the.
it'll change your short-term use people.
So you're okay with the short term. Your idea is offset it to where you have a director year one, nominating committee year two,
Yeah.
and then nobody year three, and then, yeah, that would work.
Because again, the trust is an appointment. That,
Yeah.
I mean, it's just the
Yeah, but I still think we could even do the trust on the same year as just making sure that the director doesn't have to find the trust the first year. I think we can still do that.
Yeah.
Yeah, I don't think the trust is that big of a deal.
Yeah, your thoughts about the map?
I think the map's fine. I'm pleasantly surprised that the numbers worked out as consistently as they did. You know, visually, I think the map, I'm pretty impressed that it's as symmetric or whatever the word is. That it's just, I would have never guessed. I don't know how many iterations he took.
You work very hard.
To get there, but that's.
Well, by the time you start plugging in where candidates are at, like you guys are at, where the candidates are at, Brian's was kind of a nightmare because there's three running. But once we got all that, it quite honestly, it was like, it was kind of like you didn't really have a choice of where you moved.
Here's a point, here's a point.
And then Jason's was tough because he had to move over because 8's out there on its own.
Carl, your thoughts about the map?
Oh, a question on this, like, you know, the nominating committee, but the other one, the trust. So the trust person, I didn't realize, can the nominating person be on the trust? And can a director be on the trust? I'm just asking.
Well, I don't know that we have that in the bylaws. I would think the director,
I know it's better to have someone else do that, but
but the nominating
In
committee.
fact, couldn't you?
see, that's what I was wondering. I was just
If I
making
can
clarify.
clarify, I don't know. We have to look at the bylaws of the trust.
We could look, but I can't imagine why you,
We make it,
why would anybody care if there's someone on the trust and a nominating? They're two separate jobs.
For functionality. not for-
right.
there's no-
No, I didn't know you could do that. That's why I didn't know.
I didn't.
I'll look into it. That's a good question, Carl.
It makes sense to almost have it that way. It's one less person.
And that's that's true.
I'm serious. It really does.
But your nominating committee people then they'd be the trust.
Well,
I don't believe it. They'd turn around and say, don't you do it.
I guess we could do that.
Because to be quite honest, Carl, even if it says something different, if that's the way you guys are gonna do it, we can.
Well,
It doesn't matter.
But I think it's getting other members involved though.
Yeah.
True.
But
Well,
I mean, if you couldn't find somebody, that would always be.
I will get that question answered.
I don't have nearly the trouble finding somebody for the trust.
Well, I'm sure that's the easiest one to find because it's the,
You can help
It's fun.
determine who.
but yeah, you get a handout money. I mean, it's not there's nothing thankless about that.
We don't want to, entertain the idea of a 4 and 3 at large.
Well, I know you mentioned something last month and we can still talk through it. If you remember, I think I went kind of around the room. I got the consensus that most rectors were in favor of.
Okay, let's go with 7. Okay. Well, I just thought if it wasn't too much to try to figure that out, just to compare, just for a reason, just comparisons or whatever like that, but it's whether you got to do it. Me, I think it would make it easier trying to find members that want to be on the board, if you ask me.
On the board of the nominating committee.
Well, if you got, that part of finding guys that are nominating, trying to find something.
but I think the director is easier to find than nominating.
Right, true.
I believe.
Give your thoughts.
I like the map the way it is,
Yeah, I'm fine. Fine with the map.
Looking for action on this tonight.
I think we'll probably, if we're trying to bundle everything together, because the request that Brian's made back to the terms.
Why don't do you want to do 2 and 4 or 2 and 1, or that's something you probably need to get? If they want a short year, if they want it to be 4.
No, I think he's fine with the short years. I think all he's saying is he wants there to be, the director is year one,
And the
nominating committee is year 2.
Okay.
So instead of them being on this exact same day, I don't think that's going to be that tough. What I would suggest, Steve, is you guys go ahead and vote on the red lines that don't have to do with the cycle. So that I mean, we're getting close
We
here.
wouldn't change necessarily anything in this, you talk about the cycle of voting.
Correct. Don't
Yeah.
change any of that. Just approve this.
Approve the map. Okay. Let me hear from Suzanne and Clay. Suzanne, your thoughts about the map?
I am fine with the map. I was kind of doing the math here myself. You know, we were averaging 834 members per district. Now we're at 948.
Okay.
Kind of just looking at the number of members in district. So that makes sense to me. I really have no questions on the map itself. I kind of agree with Brian, but I'm not sure the best way to fix that.
Yeah, it's complicated. I agree. Hey, Suzanne, one thing for yours too, just to let you know we tried to note it on there, but the new apartments that are going in, so there's one that's almost done. There's 2 more buildings coming. They're saying yet this year, but I don't know. Anyway, those are 65 new members that are not today. So in other words, your number today is 65 lower than what it shows on there. But once these apartments go in, it goes up to that 960 or whatever. Does that make sense?
Yeah, I'm the only district that goes down.
Yeah, probably right.
Yeah, I'm down 127. Everyone else is up. So I'm the only one losing members.
And Clay, your thoughts?
On this, and I'm trying to figure out where I thought I read it. Is there going to be, did I see somebody as director is going to be a 1-year term until everything plays catch up?
Not on a director, no. It would be a nominating committee.
Okay, then, okay, that's what I was trying to find here as we were talking.
That was another requirement, Clay, is we're not going to do a short. You can't do a short, you can't have a director be on here for 2 years, 1 year. But nominating committee, yes. And trust board, yes.
No, that's why I thought I was going to try to figure out how it was going to handle, we were going to be able to handle a 1-year term. Okay, so if it's just a nominating committee, I'm fine. And I'm fine with the map, the way you got everything set up.
Good deal.
Just one thing I'll say, with my way I say to do the cycle elections, it will be the first year of a director that you will have to find a nominating person. But I'm fine with that because you can open it up for the nominating committee to help find those people.
Oh,
I would
so you're-
rather.
you're saying there's-
Because
Okay.
it's for directors year 1, nominating committees year 2. Since that first year director would have to find a nominating.
Right. That's why he put them
But
on.
I'm fine with that.
but they'll have been on the board for
No, no, or 9
6
months,
several
2 months, or whatever.
Which I'm fine, and then, yeah, like I said, we open it up to the nominating committee. To
As long
help
as you guys
them
run
out
that.
to, I mean, I'd rather a board member find somebody their first year than a nominating committee person, find a board member on their first year.
I agree with you. Okay. And they'll have 6 months as being a board.
Yeah,
So I know, Carl, you mentioned something a moment ago about at large. Are you good with what we have?
Oh, but if everyone else agrees with me.
Right, okay. So I am willing to take a motion for the approval of the maps that,
First of all, is it, if we're changing everything like this, is this just our decision or should we do members vote on this? I mean, that's what I'm.
well, we, remember when we changed the bylaws to support going to that and then, no, so it's a
Directors are the only ones that vote.
board decision to support this map.
The way you need to get members to vote on anything is if you're changing in articles of incorporation, then you gotta have. But bylaws are just a super majority, like the members don't. You could always survey.
I was, we're changing bylaws. We're also changing district.
Yeah, but that's bylaws.
I understand.
In other words, Carl, what I meant was the bylaws describe and define what the districts are. So it's actually a bylaw change. Now, if you change something in an article on corporation, you need, the members have to vote on that. Districts, they do not.
So the motion that would need to be made lines for the map changes then, right?
I mean, I could go as far as saying approve everything as long as the cycle of elections are changed the way I stated.
That's a good.
I would make that motion.
Or you didn't have it making.
Yeah, that's the motion I'll make. Approve everything pending or dependent on the cycle of elections being changed to the way I'd stated before, year one and nominating committee being here too.
I'll float those by you guys, obviously, before. Publish it.
Go first,
I'll second.
a second. Any additional discussion at this point? All in favor, say aye.
Aye.
Hi.
And Carl, you were an aye as well, correct? Motion passes. All right, you're gonna give us a little more information, I guess, about the day of the solar eclipse, Brad? You gonna be sunny that day or?
This. All right, so plan is. I'm seriously so sick and tired here. All right, so weekend, Jeff and Evan are on call. Jeff's gonna take, Evan will take home a pickup truck. Caleb then and Larry take over on Monday. Caleb will take a pickup truck home. So Evan and Caleb both take pickup trucks home on Friday. We are gonna stage bucket trucks where I mentioned in there. We're gonna put a digger at Steve's house. And then the idea is that we are gonna be off. I'm asking all employees to take home their, Crystal and I will monitor CRC because we will get CRC messages for members calling and stuff like that. We do have 2 handheld radios that are connected to our trucks. In case we've tested all of our trucks, radios, everything works. So there's 2 radios here. There are 2 handhelds. So I'm going to have a handheld and whoever's on call, the lineman. So it'll either be Larry or Jeff will have the other one. We have worked with EMA. Brad is working on getting us, it's a card that has a number on it and it gives us priority access where if our guys happen to need to get a hold of dispatch at 911, they'll have priority access. Essentially what it is this number trumps any other number that would happen to call 911. So we'll have that and they have our information from EMS standpoint. We've worked with CRC. They know that they're going to be doing calls. I think that's it for now.
Okay. All right, so there's a plan in place. The next item has to do with fiber project. There's a lot of stuff in there.
Yeah, so a couple things real quick, and then I'm going to let Matt take over because Matt's got a presentation. I don't think we need a decision tonight on business structure, but we need to get discussions going. How do you want to set this up? Is it a joint venture? What's it look like? We got to start working on the definitive agreement with SCI eventually. And so we kind of want to go into that knowing what the board kind of wants. So Matt's going to go over that here in a minute. So some of the recent challenges that have come up, if you look at bead maps, they are pretty changed. So if you look at and I wish I would have had it, but there wasn't a good way of bringing it up. So for next level, the requirement was 100 by 25. So 100 down, 25 up. It changed for bead because it's federal to 100 by 20. Believe it or not, that 25 to 20 allows watch for some of their territory, for some of their people to meet those requirements. Now, we know from looking at the maps and knowing who Sam's one of them,
Who has watched in our community,
that that's not the addresses that are not on there that Watch says they serve ain't the case. The problem is the burden of proof is on a challenger to challenge that. So we met with the IBO yesterday. They understand and support exactly what we're saying. The challenge process, the way it works is, number one, you got to find 6 members in a census tract that have Watch communications and have not the lower level package, but the highest level package. And you got to get them to do 3 speed tests on 3 different days. And you got to get them to upload their bill that shows they have the at least 100 by 25 service, which isn't their lowest level. Most people have, like Sam, have their lowest level.
because there's no point in buying the highest level because you don't get any better service.
That was our argument to the IBO is this challenge process is impossible. No one's going to do this for us. So a better way that they've talked to us about is doing a propagation study based upon where their towers are at, which are all public knowledge.
Engineering study.
It's an engineering study that
Does
basically
their equipment have the ability to do it?
and we know what the answer to that is, but we're gonna have to spend some money to do it. So it's all gonna be staying under the budget of the original dollars that we have for grant writing. But we're gonna have to make a decision on what path we want to go because that has to get going. This is our biggest risk right now for BEAD dollars because I'm telling you, it wipes out 3/4 of the addresses. So if we get, our worst nightmare here is we get one area for next level and then we can't get anything for BEAD. So there'll still be some that we can get for BEAD, but it's a night and day difference. So I'm hopeful, the IBO is hopeful that if we can do this propagation study, this engineering study, it is a valid challenge. We have 3 or 4 weeks yet to do it. And it's going to be very, very hard for Watch. Once you put the burden of proof on them, it's damn near impossible for them to do anything. So that'll open all those back up for BEAD.
What's the IBO?
Indiana
Broadband Office. So that's kind of where we're at on that. Dale did get a letter from Airwave. Interesting enough, the guy that runs that, we've met with him before. It's not true fiber to the home. And I will tell you that there are some people that are on that in Southeastern's territory. And he didn't give me the exact number. He said almost all of them that were on the Airwave have moved over to our fiber. So Keith felt like, don't worry about it.
Because you said this gentleman's father works at Southeastern.
Yes. Dad's the operation manager at Southeastern. And if you read that letter, it was, if you want Brenda Plain's opinion, pretty poorly wrote.
Well, the first statement, Airwave Networks will be starting construction of a fiber network project on your road very soon.
See, he uses the words fiber network, not fiber to the. So. Because you could build fiber and then put wireless on it and call it, it's a fiber network. But it isn't true fiber to the home. And that's just based off of Dale, what I've heard, so.
Well, it didn't make sense when I first got the letter and I knew what our numbers were. There's no way that, because I talked to this young man a couple of times. There's no way that he had the financial wherewithal to do a fiber to the home project.
You got pretty good.
Fine.
All right, so I'm gonna let Matt go over, you might want to give him a minute for Brian to get in. I'm gonna go use the restroom, but Matt's gonna go over. I don't think we need any decisions tonight. We just need questions. We need to know what you guys need in order to make a decision eventually. There's essentially a couple different options that you can do. You actually heard Earl kind of tell his opinion, and we've been working with Earl as far as where do you want to go. We've also gotten Aaron involved in this. You guys hopefully read through the memo that gives some of the options, the pros and cons. But we need to eventually get down to a spot where this is what the board thinks we need to do, so that when we start the definitive agreement with SCI, we know what we're asking for.
I have an opinion on what we should.
And Matt has an opinion. So anyways, I'm gonna let you take it away. I'm gonna
Do what?
just give us your opinion.
We need to do a JV agreement and run it as a division under the RMC. I've talked to 5 different co-ops. I've talked motion. I'm fine with that. Talked to 5 different co-ops. I've talked to our legal representative, our auditors, and I mean, it's how Southeastern does it. It's how, I mean, Jackson had to pull it under there as a division under because you can't borrow RUS money if you run it as a subsidiary and it's not part of your, that's just how it needs to be. That's the best way to do it. I mean, I told Brett said I had to go talk to the people and get my slides so that I could, even as I said, he churched them up for me and added the stuff at the bottom. I had a white slide presentation and he added the stuff to it. I mean, he can go through the rest of them, but I mean, this is what we need to do. And I got all the reasons listed in the slideshow. I mean, that's my opinion. So you can take it for what it's worth. I mean, I don't see any advantages to being I mean, there are advantages to being a subsidiary sometimes, but I don't think they exist for us based off what we're doing. I mean, we need to own the backbone. So the backbone needs to be under the REMC just from a borrowing standpoint as well as an RUS. And so we're not going to own all the stuff in the home anyway. So what do we really gain from that? Is kind of my thoughts. I mean, what we own, we need to keep in the anyway. You don't have to get separate tax numbers. You don't have to have separate. It's just division. I mean, you'll run it under NISC, the same accounting software. You just have codes 1 or 2 based off where you put it.
So then there'd be a consolidation.
It'll consolidate up.
Tax purpose.
We won't ever have to worry about the 8515 test. That's lower not for profit because anybody who's an existing member will stay. I mean, their fiber will be part of the membership. Okay. Is how I would recommend doing it. I mean, if you're a member of the electric side, you're a member on the fiber side if you take it. I mean, there's going to be probably some Duke people to get the grant money that we're going to have to, but there's not going to be enough of them to blow the 8515 test. But get his little footer there so I can move on to the next slide. So REMC, we're going to bill all the fiber customers under the REMC. We're going to directly on the fiber. This is the advantages of making it as a division. No separate accounting or operation software. RUS loans on fiber as the backbone and connectivity has direct electric use. RUS has required other co-ops to consolidate the separate entity. From what I gathered, one of our nearby co-ops was forced by RUS to roll their sub back into as a division. So why fight them? Disadvantages, no liability shield with a separate entity. I don't really consider that to be a huge disadvantage because, I mean, how much of a liability shield you're going to have with the same employees and the same resources? I mean, it's not as clean a separation. I mean, that's a JV is not as clean a separation as a separate subsidiary. But I mean, if you put it as a division, you're still going to be allocating costs no matter how you do it because you're going to be using the same people. The gain you get there just isn't. It's not a true subsidiary, is what I would say. It's not like you got a separate business that's being run out of a different building.
Standalone.
Yeah. So then fiber is in the power space, ADSS. I mean, we have to own it. It can't be a subsidiary. It ain't like we got to own it where it's at. So the backbone fiber that we got to own it in the REMC. So, and then I spoke to several co-ops in the fiber business and I spoke with our lawyer and London Woody, and that's what they recommended was to do it that way. I mean, so I guess I think we need to run it as a division under the REMC. And have a joint venture agreement. That's my professional opinion.
But there are advantages and disadvantages.
And you guys read the memo from, that was in there, but that's pretty much, I mean, there's your advantages and disadvantages. You can. My personal view is how we do things, it needs to be a division. Or how we're going to do it. So yeah, if anybody wants to make a motion to do it that way, I will play.
We need to know that now.
No, I don't think so.
I don't need to know that today, but
Why don't we plan on doing that next month?
okay.
I don't know what will change. So appreciate your recommendation, but anybody have any additional questions for Matt as it relates
Is
to
there a
this?
possibility that this fiber project jumps leaps and bounds and a possibility of selling it off to a bigger company that?
Yeah, think about that. Yeah, there's a possibility.
So with that, which of those would be the best to separate from the
The
subsidiary?
problem you run into with the fiber, we're gonna use those in this power space.
It's gonna be hard to sell.
For us to sell this fiber business, it's not like the strand and lash that everybody else put, because this stuff's right next to the neutral.
Advantage it's giving us.
Yes.
Makes it difficult.
Yes.
And I can say it's impossible, but it definitely would.
Practice. Our competitive advantage to putting it in the power space is also a competitive detriment to selling it. Should you try to sell it? That's the other reason why I feel like the odds of us being, if we were doing strand and lash, it would sway me more towards I mean, that is one of my considerations I put on there is it's ADS fiber instead of strand and lash. Because if you strand and lash, you're out of the power space. It's probably easier to sell. With it being in the power space though, that gets, I feel like that kind of, just from a physical location standpoint, you're on the pole, I mean, if you go to sell it to somebody else, they're gonna have to move it, right? I mean, they can't be in our power space.
I mean,
I
I wouldn't say it's impossible. It would be tough.
Yeah.
I get it. But I don't think going the route that Matt's talking about here doesn't mean you can't at some point separate it. I think it's more difficult.
I mean, to separate it from a division I mean, that's not hard for me. I mean, you just split it up.
I guess what I'm saying is if it ever became an option to sell off fiber business, I don't think which route you go here is going to be a bigger deal than the fact that we are in the power space. That's going to present challenges. That's going to present like, you're going to have to do some type of easement type. I mean, I'm saying if we were to agree to sell it to somebody and give them the rights to our power space, theoretically, it could probably be done, but I don't know if you'd want to do that. I don't know how that would be done. I do think it's a consideration we need to talk through. I mean, I agree. That's going to be the other thing on this is the separation piece is going to be important to how we write into this agreement. I mean, because when you write these agreements, unfortunately, you have to write them to be able to have a path to do the things you never want to have to do. But you got to look, and that's where we're going to use our attorneys. And this is the same way that this is the same way that a lot of them are doing it. But I don't think it in
The ADSS part is.
yeah. It was kind of funny because we met with, we were interviewing somebody. I think it was an interview. We were having a conversation with somebody and they had some experience with fiber and they're like, if I were anybody, I would be doing ADSS without a doubt. It was like, that was interesting.
Greg, could you reach out for an attorney before you make the decision on Matt's request to see what would be the best based on Steve's question, if it would be a subsidiary or a separate EIN number, if it would be sold separately?
We can definitely research that if that's what you're asking.
Yeah,
Is
I
that
think
what
that
you
definitely
meant?
needs a reply. Or
Absolutely.
suggestion.
Absolutely. We can bring that back. And what I would suggest is ask questions. You guys are going to think of stuff when you get out of here. Fire them over to us and we'll in fact, if we wanted to have legal representation here for next month, we could. But I would suggest, I'll add that one, Suzanne, as an action item. and we'll run that one down with legal. But any other questions that you guys might have, fire them over to us as quick as you can. We'll start getting legal responses to these. I think she mentioned something in that memo about separation, but I can't remember. It's been a while.
There was a lot there.
I'd read that document like 15 times before I can make sense of it, just to be honest.
Well, it's got, this is possible, that's possible. It gives you 15 different ways to do it.
Good points. All right, again, if there's any additional questions that you may have regarding this, don't hesitate to give it to Brett. And so we'll go to the next item, affiliated organizations.
Yep. Hometown, we met on the 18th, and it's kind of good transition from legal. We had a legal present and going over things to clean up with hometown. I'm sure Brett, I don't know how much detail to go into with this.
Yeah, I mean, essentially, I can kind of do it a little bit. So when we had the lawsuit, we kicked off a legal review. It was part of the budget with hometown. We did a legal review, and there's a lot of things that need to be fixed. Pretty minor things like the name of the company's not spelled or is not correctly. Should have like an LLC on the back of it, does not have that. And legal jargon, that stuff matters. So we're fixing a lot of that. The other big change is that no one can seem to find an actual signed document when Bartholomew got out of the agreement that's in place today. The insurance provider, they're asking us to ask and see, can we name Premier and the REMC on the actual insurance document, which I'm sure that's going to cost us more, but we're going to ask. Other than that, it was just a lot of clarifying, like, are you doing what the thing says? Do you guys agree with this? So we're basically going through a review of all the contract. Oh, the other big thing is we do have an agreement of how the business works, but we don't have a service contract that actually spells out who does what, which is what you really need from like an insurance purpose and who's liable for what. So essentially we proposed all this to hometown. Premier was good with it. We were good with it. Now Crystal is working with legal to redo the documents. We're probably going to have to re-sign into the agreement. It sounds like a heavy lift, but I don't think there's going to be any issues.
Does this all stem from the?
Yes. It stems from the legal liabilities. Hometown ended up having to pay some money in that lawsuit, or our insurance did. And there was a point in time where we thought it was going to drag over to REMC and the Premier Ag side of it. And so essentially we need to make sure try to think of a nice way to put this.
Dot our I's and cross our T's.
The agreements aren't written well. And so there's some details that need to be added in. And I think we've covered it with Premier, and Premier's like, yeah, that makes sense. Now it's just getting it done. Did I?
Yeah, then we meet again on May 30th to approve all that. I think.
Yep.
Yeah. That's it. That's it.
All right. It was sort of an awkward situation because
Yeah.
we're
I didn't know how.
talking to a lot of the people that kind of created the business from the start and saying, this needs some work. We're not doing our due diligence as far as legal liability from Premier side and from Decatur County REMC. The whole point of an LLC is to limit the liability.
So is this who's working on your behalf or is someone working on?
Aaron from Car Ritchie is working on our behalf for hometown. So hometown's paying. It was put into the budget
beginning of the year because we knew we were going to have to spend some money on it. So no, it's not going on our bill.
Hometown previously didn't have its own lawyer, right? Until now, yeah.
Correct.
So that was kind of an issue with them.
It's been interesting and kind of awkward. Would you agree?
Yes, that's why I didn't want to branch and stuff. So.
All right, Jason, you're next. I think you just had a Hoosier board.
Exposure, yeah, I had a finance and audit committee meeting on the 14th of this month. We had a regular board meeting on the 25th, and then next Tuesday, as some of you know, we'll have our annual meeting in French Lick, which I think several of you are going to.
Wednesday.
Oh, Wednesday.
Yeah.
I'm going Tuesday, I think. Tuesday, and Wednesday. The highlights of what happened this month, we did have our audit results and findings. We went through that with no issues. We also allocated the 2023 patronage, and I think Brett's probably been sent a copy of our allocation from that. We have a market-based rate customer that has not started yet, even though they were supposed to. So we amended their contracts to try and help them get going so we could collect some revenue. And that is about it for the month.
As far as IEC goes, there were no board meetings, or I wasn't involved in any committee meetings, but it just so happened that I think it was about a week and a half ago, all the IEC directors and CEOs were invited to go listen to Mike Braun speak in front of anyone that wanted to participate. There was not a lot of participation, but Brent and I did go to the event last Friday, and he is a friend of broadband, the REMCs, but he gave us his little talk about what he would do if he became governor. So it was interesting. I'm glad I went. That's it as far as IC goes. Our next meeting next month. So the next item then is director training and conferences. I know there were 3 of us that were at the NRECA in San Antonio. Was anybody else involved in anything else? So we'll go around. Carl, I'll start with you, and if you can share a couple takeaways that you took from that conference.
Well, you guys voted me to be the representative of vote. Get the Smith there. Yeah, he got me to do it. No, that was okay. There was guys from Colorado who were just kind of making sure things were worded properly. Yeah, so it would have been a lot quicker and smoother if they wouldn't have been there against, but that's about it. But as far as taking on the breakout sessions, that Pat, man, how do you say his last name?
Mangafe.
He's an idiot. I swear to God. I got nothing out of that session whatsoever. If he wouldn't have been there, probably would have been a little bit better off. Now, I did get, there was another session that really didn't help too much, but there was another one that was, guys from Arkansas talked about blackouts. And they said, do whatever you can not to do it. That's what they said. That's basically the answer to that. They said it's a horrible thing to do, and don't do it if you can't. Yeah.
Sure.
Okay. The other thing, the other one I got was had to do with the USDA and stuff, and they also said that they do have carbon credits for solar. So, and I've already had a couple of members call me about carbon credits for solar. So I got some numbers there that I haven't had time to follow up on that. But other than that, that's about it.
Okay. Jason, you have a couple takeaways from?
Yeah, overall it's good. I think I agree with Carl. I didn't find a tremendous amount of value in breakout sessions. I attended one on broadband and one on a futuristic, I don't even, they weren't that, I was way more impressed with the keynote speakers, especially the last day, the last guy. And I really honestly wasn't really looking that forward to his conversation, but he was the best speaker of the whole event. And he was kind of a futurist, but he kind of was putting in perspective changes that we've seen. And concerning, that was one of the other breakout sessions I went to was AI, which I didn't really care for too much. But this guy talked a lot about AI and the changes we've seen in, the last 8 or 10 years and what that's going to translate looking forward in the next 8.
In a much shorter period of time.
But here's one huge takeaway I took out of his whole thing. And this kind of relates maybe to some stuff that we've got going on here. So he was doing an AI presentation and they asked the computer, was it 3 questions or 5?
I think there were just
3 questions. And one of them was like, what could the distribution co-op do to help attendance at their annual meeting or something, so it gives like this big, long kind of generic answer. The computer did for all 3 questions. When he got done with that, he showed a bottle of water on the screen. And he said, now that exercise to get those 3 questions answered took this bottle of water to cool the computers to answer those questions. Like, in other words, that's going to be a problem.
Mm-hmm.
That's going to be an issue. But anyway, he was the best part of the whole thing. And I also, it was good to talk to other co-ops. I asked a lot of questions about nominating committee to folks just to see where they were at and what they were doing. And we're in the minority on nominating committees. Most have done away with them. So, but that doesn't matter. I mean, that's just something I learned.
Jason, excuse my ignorance, the bottle of water to cool the computer, meaning what?
It took this much water to cool the computer to process the 3 questions that they did live for the group.
CPUs put off so much heat.
As they cool them, they
CPUs and do AI and the energy.
It was his whole conversation was based around AI, and I'm not that interested in it.
Or not, but it's
But-
unreal.
I think we're gonna.
You're going to have. I mean, of course, the moral of the deal was don't stick your head in the sand. If you don't understand or you're afraid of it, lean into it because you're going to need to know something about it.
It's interesting.
It's scary. Yeah, it really is. But
And that'll be online.
Really, really good. That was the best part of the whole thing. And the Secretary of Agriculture was there, and I guess I can tell you guys this now. He announced that day this new air funding from the government.
Yes.
He announced
That's true.
that day, or that, that 7 states had been invited to apply, and Hoosier was one of them.
Yeah.
For the nuclear project. So they did lower our $1 billion ask by 30%. So we're down to 700 million, but
That's it?
Only $700 million.
that is still 100 million. Yeah. So that was very good news.
So I have to piggyback on what Jason said about AI. And it really was an incredible session. And I mean, he had everyone's attention that was still there. And, it was certainly well done. The other thing that I was impressed with is they have they pick one from each state, the youth tour. We send 3 or 4 from here now. I think we have 4 in the budget for this year. They all congregate out at DC, but they pick one student from Indiana to be represented at the NRECA convention. And they introduce them. I mean, they have various jobs throughout, but they have to pick one from their own to give an address. And this young lady did an incredible job. And I think we're in some good hands with the youth that we witnessed anyway. Couple breakout sessions, and they were a little bit challenging to to stay, but there was one, and I think most of you have heard the story, if I can find it here. It has to do with an REMC from South Carolina that the whole board basically got fired. I don't know if you're all aware of that. And this is something that happened 6-7 years ago, if I'm not mistaken. And the CEO was present, and he he kind of talked through what his experience was, how he had to kind of lay back a little bit and not really get completely involved and tell the chairman and the rest of the board that they weren't doing things correctly. It's an interesting topic, but so that was a breakout session, and they did a good job as well. So
That was really, except the things that they were citing that they were doing.
oh yeah, so they had increased their stipend. They doubled and tripled it, and they created like 2 or 3 additional meetings every month.
Phone calls was like a stipend, all the things that you should know.
Did you see that one? Okay. So
Didn't I sit next to you?
I think you did.
That was, hey, I have the number one key takeaway out of this deal was do not let Brett handle the airline reservation.
Well, you realize you probably came close to beating us back.
Wait, what?
You probably came close to beating us back home.
When that night?
We didn't get home.
Oh, when driving, man.
We got home.
Oh, I don't-
Got there,
We got, you got home Dallas.
by driving, they didn't.
I drove.
We had to stay overnight an extra night.
You did.
In Dallas.
Get us registered in time.
You probably beat us home. Seriously.
I did.
There was a couple times he said, oh, Carl, damn it.
No, and that wouldn't like that.
All right. Anything else? Make a motion to adjourn.
Oh, wait, one more thing. Matt, congratulations on the audit. You and your staff.
Oh.
Good job.
Thank you.
Good job.
I give Jenny lots of credit. She's the one who prepares that.
Well, y'all did good.
Speaking of Jenny, Steve and I left our tax packet on her desk earlier this evening, so.
She'll say it. She's off this week.
Yeah, she's on vacation.
One other thing, CFC just opened up their registration for the Indianapolis.
Oh, I see.
But you gotta know what you wanna attend before you register. That's the kick in the teeth part. You gotta pick them as you register.
No, it opened up. I didn't get an email. I just went on there today.
So I'm glad you said something again.
You gotta pick your breakout sessions.
I certainly would encourage you guys to go ahead and register. I don't think there's a cost to register.
No, it's free, but you gotta pick your breakout sessions.
We're gonna try to get something together to maybe where we can caravan or all go together for those people that wanna go on Monday, Tuesday, / Wednesday. I think Wednesday is a very short
Wednesday,
day.
half day. Well, Monday doesn't start till 10.
Oh, does it? Okay.
No.
They've got training on Sunday if anybody.
Yes, training's there. And if you're going to stay, you need to book a hotel now. Because I'm telling you, they will, if not, you're gonna be so far away, you may as well drive home.
That's true.
I booked mine.
And those are 17th of June?
17th, 18th, and 19th. And there'll be breakout sessions, I think, on the 16th. If anybody wants.
It looks like
trainings.
Oh, training, yeah. Financial stuff usually.
Usually, yeah, I think last year I did equity management.
Yes.
On Sunday.
Are we done?
Need a motion.
Make a motion.
Making a motion to adjourn. We're adjourned.
And you don't need to sign these. I've screwed